So hello my dear ones, and today we will be discussing our chapter number 2, that is the chapter number 3 as per the order, but our second video on this Maha Marathon revision series, that is the chapter salary. Alright, so hope you have seen video number 1, residential status and scope of total income, because in that video I am clearly explaining on what exactly is this Maha Marathon, and this Maha Marathon was intended for whom and all. So today, without wasting time, let's start with the second video, that is salary. So we have summarized the entire salary chapter in a way that all those frequently asked areas have been summarized and it has been made crisp so that when you revise this respective topic, your revision will get over in a quick succession. Now, we'll start with the first component in the head salary, that is the basic salary. So in every examination question, they will mention, if it is a dedicated question related to salary chapter, they will be mentioning the basic salary. So what to do with the basic salary? Basic salary is definitely a taxable component, and the basic salary have to be taxed on the basis of either due or receipt, whichever is earlier. So the basic salary always have to be taxed on the basis of due or receipt, whichever is earlier. Say for example, your relevant previous year for your upcoming examination is say 2024-25. In the year 24-25, they are saying that, say you have received salary from 1st April 2024 to 31st March 2025. Obviously, you have to consider the entire basic salary while computing the salary income. However, say in the question they are saying that April 2025 salary has been received in advance in March. In March 2025, you have received an advance of salary. That advance is for the month of April 2025. So what we can say is, it is received or due, whichever is earlier. So if you are receiving that April month salary as an advance in March 2025, that advance also will be taxable in the year 24-25. So you have to remember this particular thing, because when you take basic salary, always this basic salary have to be taxed on the basis of due or receipt, whichever is earlier. So in the question, you have to carefully analyze whether that component of basic salary is a part of your relevant previous year or not. So this has been tested in September 2024. That's what I'm saying. When they are saying April month salary have been received in advance in the last year, you have to consider this as a part of a salary component in the relevant previous year itself. Now, moving on to the next one, that is in full, depending upon the number of months worked in that year. Say for example, they are saying that the employee have joined the company from 1st January 2025 onwards, then only 3 months salary will be taxable in the year 24-25. So always when you write this adjustment in your exam, make sure that the joining date, you have read that joining date in a proper manner. Otherwise, your basic salary computation will go wrong in examination. Now, they may also use a word called scale of 20,000 -1,000 -30,000. What do you mean by this scale of? Say for example, it simply means when you join a company, your first year salary will be 20,000, and every year you will get an increment of 1,000 and your maximum salary will be up to 30,000. Say for example, if I joined a company on say 1st October 2024, then till the next September 2025, my salary will be 20,000. Then from 1st October 2025, my salary will be 21,000. Every year there will be an increment of rupees 1,000, and it may reach up to 30,000. The 30,000 is the maximum expectation, or is the maximum salary that I am about to receive from that respective company. Every year I will get a increment of rupees 1,000. That's what it means. So 20,000 bar 1,000 bar 30, scale off. That simply means every year you will get an increment of 1,000 and your maximum salary in that respective company will be 30,000. So means starting with the 20,000 per month for year 1, thereafter 1,000 increment every year, maximum salary will be 30,000. This is what you should understand. Now, that is the first component in relation to the salary head, that is a basic salary. Second one, dearness allowance. They also may give the dearness allowance. Dearness allowance in full should be always considered. You have to always consider the entire dearness allowance, whether the dearness allowance forms part of the retirement benefit or not. You have to consider, you have to pay tax for the entire dearness allowance that you have receiving in the respective previous year. So always make sure that you have taken the entire DA for the purpose of computing the gross salary. Now, moving on to the third component, that is bonus, that is taxable in the year of receipt. So friends, please listen. Say in a question, they are saying 23-24's bonus and 2024-25's bonus. 2 years bonus you have received in October 2024. They're saying, say 23-24 bonus is 15,000 and 24-25's bonus is say 20,000. So both this 20 plus 15, that will be 35,000 will be taxable in the year 24-25. So bonus always will be taxable in the year of actual receipt. It is not taxed on the basis of due or receipt, whichever is earlier. Rather, you have to tax it always in the year of receipt, irrespective for the year in which it is actually paid. So always bonus have to be taxable in the year of receipt. That's what you have to be careful about. Moving on with the next component, that is allowances. So when we discuss allowances, we can divide allowances into three. Number one, fully exempted category. Number two, partly exempted category. And the third one is fully taxable category. So I have listed out all those important and frequently asked components of allowances. So first category, that is fully exempted category. Let's understand which all are the items coming under the fully exempted category. Number one, received by employees of United Nations. That simply means if you are an employee who's working with the United Nations, you are working in India, in either a branch or a project office of United Nations, and you are receiving allowances from United Nations, that entire allowances shall be fully exempted. If you are an employee who's in receipt of allowances from United Nations, you don't have to pay tax for that respective allowances, because that allowances is fully exempted. We can say it is fully exempted. So all those employees who are in receipt of allowances from United Nations, fully exempted. Second one, that is received by an Indian citizen from Government of India for services rendered outside India. That simply means you are an Indian citizen. Say you are an embassy officer working in USA, Indian Embassy USA. So the Government of India will pay you what? Allowances, perquisites, salary, etc. All the allowances and perquisites received by those employees who are working outside India, which is paid by the Government of India, shall be fully exempted. It is intended for our embassy officers who are working in our Indian Embassy office, which is in overseas. So if you are an Indian citizen, you are receiving both perquisites and allowances from Government of India. Both are fully exempted. Here both perquisites and allowances are fully exempted in your hands. But the basic salary, DA, etc. will be fully taxable. Only you can claim exemption for the perquisites as well as for the allowances. Hope you are getting my point. So we are quickly revising all the important frequently asked components in the head salary. Now, so that is all about the fully exempted category that you should study. Two things. Number one, allowances received from the United Nations. If you are an employee who is working with the United Nations, you are receiving any allowances, fully exempted. Second one, if you are an Indian citizen who is working abroad and you are getting allowances and perquisites from the Government of India, fully exempted. Then the second category is partly exempted category. So here the allowances that you are receiving will not be fully exempted. A part of allowance will be exempted. So let's understand which all are the items coming under the partly exempted category. Item number one, house rent allowance, which is under section 10(13)(a). So if you are a person receiving house rent allowance, you can claim an exemption under section 10(13)(a), and let's understand what exactly is that respective exemption. So what they are saying is, first of all, you write down your entire actual HRA received. Then out of these three limits, you can pick the lower one, and the lower one you can claim as an exemption. So lower of these three shall be exempted under section 10 subsection 13(a). Lower of these three you can claim as an exemption, and that's what we are about to discuss right now. So item number one or component number one, actual HRA. First of all, if you are a person who is receiving HRA, what is HRA? House rent allowance. If you are a person receiving house rent allowance, then what to do? You write down the actual HRA receipt. Number two, you compute the rent paid by you minus 10% of the salary. Then you consider the annual rent paid by you minus 10% of your salary as limit number two. Then what is limit number three? 50% of salary, provided your house is situated in a metro city. Say the house rent allowance. What is the purpose of house rent allowance? House rent allowance is actually an allowance given by the employer to cope up with the rental expenses that have to be paid by the employee. So every month you will get a fixed amount as a house rent allowance. On that house rent allowance, you can claim an exemption, and the exemption is provided under section 10(13)(a). How do you claim the exemptions? How do you claim the exemption? You list out these three and pick the lower one. What is item number one? Your actual HRA receipt. What is item number two? You compute, you take your rent paid for that year and minus 10% of your salary. And what is limit number three? If your house is situated in a metro city, which all are the metro cities right now? Delhi, Kolkata, Mumbai and Chennai. If your house is situated in any of those 4 cities, then you can take 50% of salary as limit number 3. And if your house is situated in some other city like Kochi, Bangalore, etc., then you can take 40% of your salary as limit number 3. So either 50% if your house is situated in metro city or 40% if your house is situated in other cities. Metro city doesn't mean the city which have a metro. Okay, metro city depends upon the population of that respective city as per 2011 census. Now, salary here, it does have a definition for the word salary. Salary here what? Basic salary plus DA forms part of the retirement benefit plus commission if it is expressed as a fixed percentage of your total turnover. So salary here, they are referring the word salary, 10% rent paid minus 10% of salary or 50% of salary or 40% of salary. And what is the salary? Salary here simply means you take the basic salary plus DA only if it forms part of your retirement benefit plus commission only if it is expressed as a percentage of your turnover. Say in the question they are giving fixed commission every year. You don't have to consider that commission as a part of this salary definition because commission have to be considered only if it is given as a fixed percentage of total turnover of the employee. So that is what they are saying. So we can quickly revise the entire topic, friends. So listen, if you are a person being an employee in receipt of house rent allowance, you can claim an exemption as per section 1013A. Now you tell me, how do you claim the exemption? You note down the actual HRA received. And point number 2, you take out the rent paid minus 10% of your salary. Salary here means basic salary plus DA forms part of the retirement benefit plus commission if it is expressed as a fixed percentage of your total turnover. Then what is limit number 3? If your house is situated in the metro city, then you take 50% of that respective salary. Or if your house is situated in some other city, you take 40% as limit number 3 and you pick the lower of these 3 and that lower will be the exemption which is under section 1013A, and I hope you got my point. And one more thing is there, friends, if you are an employee who is actually staying in a property where you are not paying rent, you are living with your relative or you are living with your parents, then you cannot claim any exemption for the HRA received. That entire full HRA shall be fully taxable. So friends, please listen. If you are staying in a rented property and you are actually paying the rent only, you can claim the exemption under 1013A. If you are actually staying in a property where you are not supposed to pay any rent, then you are not eligible to claim the exemption under 1013A. So to claim the exemption under 1013A, you have to actually suffer the rent. That is the point. Now, moving on to the second category, which is under the partly exempted category, that is category number 2, that is special allowances, which is mentioned under 10 subsection 14 clause number 1 and clause number 2. So we are about to discuss two category of partly exempted allowances. Category number 1, 10 subsection 14 clause number 1 and category number 2, 10 subsection 14 clause number 2. Let's understand what is this category 1. Allowances where exemption is limited to amount actually expended. So this is basically under section 10 subsection 14 clause number 1, where you can claim an exemption provided you have actually spent that respective amount for the respective purpose. Say for example, these 6 items, 1, 2, 3, 4, 5, 6. For the 6 item, if you want to claim an exemption, you have to spend that respective allowance for that intended purpose. Say for example, traveling allowance. You are in receipt of traveling allowance and you have 100% expended that full traveling allowance, then you can claim exemption for the entire traveling allowance. So out of this 6, you can claim exemption provided you have actually paid that respective allowance for that intended purpose. Now let's understand which all are the 6 items coming under this category. So allowances where exemption is limited to the amount actually expended. So moving on to the first one, that is traveling allowance. What is this traveling allowance? Allowance that you have received on tour or transfer. Because this is a tour, that is for official. You are going for an official tour or you are transferred and you are supposed to travel. So if it is an official travel or you got a transfer from one place to another and you are traveling on account of this particular transfer. So if it is an official tour or if it is a travel on account of your transfer, then the allowance given by the employer to meet up that respective expenditure shall be fully exempted provided you have expended that respective allowance for the respective purpose. Say for example, you are a person who has frequent official trips. You are a supervisor of a respective company. You have to visit from one side to another. So you have a lot of official trips. Every day you have to commute a lot. For that, your employer is giving you a particular allowance every month. for that respective travel, and you are expending that entire allowance for that respective travel, and nothing shall be taxable. Say for example, you are in receipt of 10,000 as the allowance and you are expending 7,000. So the remaining 3,000 shall be what? Taxable. That is category number 1. So category number 1, what is the speciality? Your exemption shall be subjected to actual expenditure. If you are expending that respective allowance for the intended purpose, you can claim an exemption as per section 10, subsection 14, clause number 1. That's what they are saying, and I hope this much is clear. Now moving on to the second item, that is daily allowance or per diem allowance. Say for example, if you are a person who is actually working in a transport system, your employer will give you a daily bata. It's called a daily bata. If you are receiving that daily allowance or per diem allowance, just like a daily bata, you are a JCB driver or a truck driver and you are getting a daily bata for every trip. If you are receiving that daily bata and you are expending that daily bata for that intended purposes, why they are giving a daily bata? Because you have to have lunch from outside, from a hotel or somewhere, and you have to stay at some places. So you are getting a daily bata whenever there is a work assigned to you. So if you are getting a daily bata, you are expending that daily bata for the intended purpose, nothing shall be taxable. If you are not expending it in full, then the remaining amount which is not expended shall be fully taxable. That is what they are saying. That is why it is called as a partly exempted category. How much you have expended, that much you can claim an exemption. The remaining amount which is not expended shall be taxable under this respective category. And what is number 3? Conveyance allowance. If you are receiving conveyance allowance also, the exemption is likewise. You will get a exemption for the amount that you have actually spent. Conveyance means the travel between your office and residence. Then next one, helper allowance. Say you have an official helper. You have a project to complete and you have appointed an official helper. For that official helper, your employer has given you an allowance to meet up his expenses or meet up his salary. So all the helper allowance that you are getting, official helper, not the housemaid. For housemates, that's called as perquisites. That we will deal later. For if you are getting an official allowance for your official helper and you are expended that allowance for that respective purpose, nothing shall be taxable. And the fifth one, research allowance. If you are getting research allowance and you are expended that research allowance for its intended purpose, again you will get an exemption for that respective research allowance. And the last one is uniform allowance. If you are getting a uniform allowance and you are expending that uniform allowance for its intended purpose, that means an expenditure, an allowance which is given to you to buy uniforms, and you have expended that respective uniform allowance for the intended purpose, then again nothing shall be taxable, and this is what they are saying. So what is the speciality of these 6? These 6 shall be exempted provided you have expended that particular allowance for its intended purpose. If it is fully expended, fully exempted. Partly expended, partly exempted. Partly expended, partly exempted, and the remaining shall be taxable as well. I hope you are following what I'm saying. Now moving on to the second item, friends. What is the second category item, which is under section 10 subsection 14 clause number 2? The following items which we are about to discuss right now, that is item number 1, item number 2, item number 3 and item number 4. These 4 items you can claim exemption, and these are fixed exemptions. Whether you have expended or not, you can claim fixed exemptions. So these exemptions are irrespective of the fact that whether you have expended it or not, you are eligible for the exemption. That's what we are about to discuss right now, and let's discuss it one by one. Number 1, allowances given to the employee of transport system. So you are actually working in a transport system and you are getting transport allowance. Then you can claim an exemption of how much? 70% of the amount, maximum of 10,000. Say for example, you are an employee and you are working in a transport system. Friends, you have to be very careful. If you are an employee working in some other system, say you are an accountant of a company and you are getting some transport allowance, fully taxable. If you are an employee working with a transport system, say you are a driver of a bus and you are getting transport allowance. Say the company is not giving you daily allowance, then they will give you transport allowance. If they are giving you transport allowance, then how do you claim the exemption? Imagine the transport allowance given to you is 20,000 rupees. Transport allowance given to you is 20,000 rupees, either 70% of it. How much is 70% of 20? 20 per month is the transport allowance. 70% means 14,000 per month. Can you claim exemption for this entire 40? No, because maximum exemption shall be 10,000. So how much you can claim? 14,000, maximum of 10,000. That means 10,000 you can claim, and the remaining 10,000 per month shall be taxable. This is how you have to compute the exemption. Imagine you are receiving 5,000 rupees as what? as transport allowance. If you are receiving transport allowance as 5,000 rupees, then 70% of 5,000 will be 3,500 rupees. So you will get an exemption of 3,500, which is lesser to 10,000. So you can claim an exemption up to 3,500. So that is what they're saying. If you are an employee who is working with a transport system and you're getting transport allowance, the exemption shall be 70% of the monthly allowance and maximum monthly exemption shall be 10,000. It shall not exceed 10,000 per month. That's what they are saying as a part of the fixed exemption. And point number 2 under the fixed exemption category, that is children education allowance. If you are an employee who is in receipt of children education allowance, that means for the expenditure of the educational expenditure of your children, your employer is giving you a monthly fixed allowance. You can claim a fixed exemption. And how much is the exemption? Rupees 100 per month per child, that too for a maximum 2 children. That simply means, say for example, you are receiving 2,000 rupees as monthly allowance for 3 children. So 2,000 into 3 children into 12 months will be the total allowance that received by you. So the total allowance received by you will be 72,000 rupees. And how much is the maximum exemption? 100 rupees per child, that too for maximum how many children? 2 children. So 100 into 2 children into 12 months shall be your maximum exemption. So 100 into 2 into 12 will be 400 rupees you can claim as an exemption. And the remaining amount shall be fully taxable. And how much will be the remaining amount? 72,000 minus 2,400, and that will be 69,600 shall be fully taxable. So that's what they are saying. If you are an employee who is in receipt of children education allowance, you can claim an exemption of how much? 100 rupees per child per month, that for maximum 2 children. That's what they are saying. Now, this exemption you can claim. Children study or not, you are eligible for this exemption. Whether your children actually studies or not, you are eligible for the respective exemption. However, if studied outside India, you are not eligible for the exemption. If your children is actually studying outside India, then you are not eligible for the respective exemption, and that's what the department says. Now, moving on to the third one, friends. Third exemption, that is hostel expenditure. That is simply means you are an employee and you are in receipt of your children hostel expenditure. Your children is actually studying in hostel, and you are getting an allowance for meeting their hostel expenditure. For that also you can claim an exemption. And how much is the exemption? Rupees 300 per child per month, that too for a maximum 2 children. That simply means you are receiving 5,000 rupees into 3 children into 12 months as what? Hostel allowance. So 5,000 into 3 children into 12, it will be 1,80,000 as the actual hostel allowance received by you for a year. How much is the maximum exemption? Maximum exemption shall be 300 rupees per month into maximum for 2 children into 12 months. That is the maximum exemption. So 300 into 2 children into 12 months, it will be 7,200 rupees is your maximum exemption. And how much is the remaining amount? So 1,80,000 minus 7,200, it will be 172,800 shall be your taxable allowance. And this is how you have to compute. So here also your children studies or not, you are eligible for the exemption. However, if your children is studying outside India, you are not eligible for the exemption. So in both the cases, for both the education allowance as well as hostel expenditure, you are not eligible for the exemption provided your children is actually studying outside India. Whether your children studies or not, you will get an exemption. If your children studying in India also, you will get an exemption. But if your children is actually studying outside India, you are not eligible for the exemption. That's what the department says. And point number 4 in this category is the transport allowance to those employees who are blind, deaf or dumb or having disability of lower part of the body. That simply means if you are an employee, either you are dumb or deaf or you are actually blind, or you have a disability for your legs, lower part of the body, you have some problems with your legs. Either you don't have legs or your legs is actually paralyzed or something like that. You have a problem with your legs and you are receiving transport allowance. It is fully exempted. So please listen, friends. The point is like, it is fully exempted, but there is a ceiling limit for this as well, friends. And how much is the ceiling limit? That is 3,200 rupees per month is the ceiling limit. So if you are an employee who is actually working in transport system, sorry, not transport system, you are working in any system, whether transport system or not. Say you are an accountant of a company, but you are either blind, deaf or dumb, or you have a problem with your legs and you are receiving transport allowance and you will get an exemption. That is a full exemption. However, there is a ceiling limit. And how much is the maximum limit? 3,200 rupees per month. Say for example, you are receiving 4,000 rupees as the allowance, you can claim an exemption up to 3,200 and the remaining 800 into 12 shall be taxable allowances. This is what the department says. So transport allowance given to those employees who are either blind, deaf or dumb, having disability of lower parts of the body, you can claim an exemption up to how much, friends? 3,200 per month. That's what the department says. So friends, in examination, if they are in the question, if they are saying that you are in receipt of transport allowance, say if they are mentioning transport allowance in the examination question, then first thing that you have to check whether you are an employee of a transport system. If you're an employee of a transport system, then how much is the exemption? You can claim 70% of the monthly transport allowance subjected to maximum how much? 10,000 per month. Now, if you are an employee who is working in some other system, but either you are blind or deaf or dumb, or you have a problem with your legs, lower part of the body, you have a disability. In such a case, how much is your exemption? You can claim an exemption. If you can say that it's a full exemption, however, maximum ceiling limit is there, that is 3,200 per month. You can claim an exemption of how much, friends? 3,200 per month. And if you are a person who is actually working in some other system, like you are an accountant of a company without any disability and all, and you are receiving transport allowance, it shall be fully taxable. This is how you have to deal with the transport allowance, and I hope it is clear for you. Alright friends, so we were discussing about the allowances. Okay, now the third one, there is the third category is there in allowances. Number one, it is fully exempted. Number two, it is partly exempted, and the third one is fully taxable. Under fully taxable, we can say transport allowance received by a normal employee. Say for example, you are an accountant of a respective company and you are receiving transport allowance. The transport allowance shall be fully taxable. You are getting some dress allowance, fully taxable, food allowance, fully taxable, medical allowance, fully taxable. So all other allowances which we haven't mentioned in these two will be fully taxable under the third category. So these are the items which are frequently asked in your examination. So that's why I've categorized these items in a smaller and simpler and a summarized way. So moving on with the next one. So we have completed the impact of allowances. Now moving on with the next one, friends, next component in the head, salary. What is the next component? Next is leave encashment. So let's understand what is leave encashment. Say for example, you are an employee in your company. Every year you can take 30 days leave. Every year you can take how many days leave? 30 days leave. You haven't taken any leave at all. Say you haven't taken any leave at all and you have worked in that respective company for 20 years. So 20 years into 30 days, you have an accumulated leave balance of how much? 20 into 30, that will be 600 days. So in your whole working period, you have additionally worked for 600 days. So at the time of retirement, you are encashing this. You are encashing that 600 days additional leave. That simply means you are a person and you could have taken leaves every year. That means maximum in a year you can take 30 days leave. You haven't taken any leave at all. Imagine it's an ideal situation. Okay, imagine you haven't taken any leave at all. So at the end of your service period, you have 600 days leave credit in your bag, but you haven't taken any leave at all. So you can encash those 600 days leave because you have additionally worked for 600 days. All right. Throughout your period, you can encash that 600 days leave into salary, and that entire amount that you're receiving from your employer is also an additional component which is taxable as salary. So when you encash your leave at the retirement or during your end phase or something, you are getting a lump sum amount from your employer, and that entire lump sum amount is basically a taxable component, but you can claim an exemption, and that's what we are about to discuss right now. So two things you should know. Number one, in certain company, every year the employee can encash the leave. If you are encashing the leave credit during your period of service, it shall be fully taxable without any exemption. And if you are a person being an employee encashing the leave balance at the time of retirement or death, no problem, you can claim an exemption under section 1010AA. That's what we are about to discuss. So let's have a simple discussion on this respective topic. So received during the period of service shall be fully taxable. If you are a person receiving leave encashment during the period of service, fully taxable. And if you are a person received at the time of retirement or death, you have received leave encashment at the time of retirement or death, you can claim an exemption under section 1010AA. That's what we are about to discuss right now. So If you are a government employee, either central government or a state government employee, then you can claim full exemption for the entire leave encashment received by you. So simply it means, friends, you are an employee of either central government or state government and you have encashed your leave balance at the time of your retirement or death, then the entire lump sum amount received by you shall be fully exempted under section 1010AA. Now, the second one, if you are an employee who is under some other category. So say for example, you are a company working in a private limited company, you are an employee working in a private limited company and you are receiving this leave encashment at the time of your retirement or death, then you can claim exemption, and the exemption shall be lower of these four. Lower of these four limits given here. Limit number 1, we call it as a statutory limit, 25 lakhs. So you are receiving leave encashment, you are receiving a lump sum amount at the time of your retirement as leave encashment. Then limit number 1 for claiming exemption shall be 25 lakhs. That is a fixed limit. It is also called as statutory limit. And what is limit number 2? You take last 10 months salary. You simply take the total of last 10 months salary. That is limit number 2. And what is limit number 3? You take the actual amount received. So whatever the actual amount you received as a leave encashment, that you can consider as limit number 3. And what is limit number 4? Limit number 4 is little bit tricky, so you have to be very attentive. What is limit number 4? You, at the time of retirement, you check how much is your leave balance. You divide it by 30 so that you will get the number of months of leave that you have at the time of retirement. So leave balance in number of days divided by 30, you will get the number of months of leave balance that you have. That have to be multiplied with the last 10 months average salary. So you take the last 10 months average salary. What is last 10 months average salary? You total the last 10 months salary, then you divide it by 10. So you will get the average of last 10 months salary. So you multiply it, you encash it. So the number of days of leave that you have, that is the balance number of days of leave that you have, divided by 30 into last 10 months average salary will give you a figure. That figure is your limit number 4. But there is one thing. While considering this leave balance, the leave balance should be computed in a way that 1 year leave entitlement shall never exceed 30 days. Say for example, 1 year leave entitlement shall never go beyond 30 days. And one more thing is there's a definition for the salary here. And what's the definition for the salary? They're using the word salary, monthly salary. They're again using the word average salary. What is salary over here? You take the basic salary, then DA forms part of the retirement benefit, then commission if it is expressed as a fixed percentage of your total turnover. So you are getting basic salary, you have to take it. You are getting DA only if it is a part of your retirement benefit, you have to take it. And if you are getting commission which is expressed as a fixed percentage of the total turnover of the employer, you have to take that commission as well for the purpose of the salary definition. So this same definition we have seen in HRA also. They are using the same definition for the salary. So for a better understanding, I'll give you an example. Say for example, say I am Mr. JK, I am working in a respective company, I worked for 20 years and 6 months. Work for how many years? 20 years and 6 months. So according to my company rules, every completed year I'll get 40 days leave. 40 days leave for every completed year. This is what the company says. For every completed year I'll get 40 days leave. So I took actually 200 days leave. In my 20 years of service, I took 200 days leave. So my actual balance is how much? My actual balance is 40 days into 20 years. Always you have to take only the completed year. Don't proportionate the number of months. Always ignore the fractional months. You only have to take the completed year, because in every company, if you have completely worked for a year, you will get the eligible leave balance. Otherwise, you will not get it. Okay. So for completed years, 20 years into 40 days, that will give you 800 days of leave. And you have actually taken 200 days of leave and the balance actual is 600 days. But there is a problem. What department say? Don't take this 600 divided by 30 into last 10 months average salary. No, this is not you are supposed to do. What you are supposed to do is, what they are saying is, leave balance should be computed in a way that 1 year leave entitlement shall never exceed 30 days. So according to the employer, 1 year leave balance, leave credit is 40 days. But it have to be limited to 30. That simply means even though it is 40, you have to compute it is 30. So 30 days into 20 years, that will give you 600 days of leave, and you have actually taken 200 days of leave. Then the remaining 400 days, this is what you are supposed to encash. So what you need to do is 400 days divided by 30 days. So how much will be the proportionate months? 400 divided by 30 will give you 13.3333 months into last 10 months average salary. This is how you have to compute the limit number 4. So friends, it's pretty simple. 4 limits are there. What is limit number 1? Statutory limit of 25 lakhs. What is limit number 2? You take past 10 months salary. And what is salary? Basic salary plus DA forms part of the retirement benefit plus commission if it is expressed as a fixed percentage of the total turnover of the employer. And what is limit number 3? That is the actual amount received. And what is limit number 4? Last 10 months average salary into leave balance divided by 30. And what is this leave balance? You assume that 1 year leave entitlement is 30 days. Irrespective of if it is more than 30, you have to limit it to 30. And one more thing is there, if the 1 year leave entitlement is less than 30, you have to take the actuals. So what department says is, the leave balance, when you compute the leave balance, 1 year leave entitlement shall not go beyond 30. That's what they are saying. If the actual leave entitlement is less than 30, you have to take that less than 30 figure only. Less than 30, actual entitlement only. If it goes beyond 30, you have to limit it to 30 into number of completed years minus actual leave taken. So the respective balance shall be your actual balance. That into last 10 months average salary will give you the limit number 4, and you pick the lower one and you claim it as an exemption under 1010AA if you are not a government employee or a central government employee or a state government employee, if you are some other type of employee. Now, you will get this exemption only if you are receiving this leave encashment at the time of retirement or death. That's what the department say. So I hope this much is clear for you. So friends, moving on to the next one. Let's see what exactly is the next component in the head salary, that is gratuity. So what is gratuity? So gratuity simply means a gratuitous payment given by the employer to the employee at the time of retirement normally. Okay, an employee may withdraw the gratuity amount. It's actually an amount which is given gratuitously by the employer to the employee. Normally it is a retirement benefit, but an employee, if he is in need of some money, he can withdraw the gratuity during the period of service as well. So gratuity is basically a taxable component of salary. And what the department say, if you are a person who withdraws gratuity during the period of service, it shall be fully taxable. So if you are receiving gratuity during the period of service, it shall be fully taxable. You are not eligible for any type of exemption. However, if you are receiving gratuity at the time of your retirement or death, you are eligible for an exemption, and let's understand how to compute that respective exemption. So friends, listen. Similar to leave encashment, if you are receiving gratuity at the time of retirement or death, you are eligible for an exemption, and let's understand how to compute that exemption. So very simple. Category number 1, if you are a central government employee or a defense services, or if you are a local authority employee, or if you are a civil servant, you can claim full exemption for the gratuity received at the time of retirement or death. So I'll repeat those 4. If you are a CG employee, defense services, local authority, civil servants, you can claim entire amount of gratuity that is received at the time of retirement or death as an exemption. Now, if you are another employee, if you are under other category, let's understand whether you are eligible to claim exemption. The answer is yes. But if you are a company, if you are an employee, say you are in a private company or other public company, you are an employee of that respective company, and you have to check whether you are covered under Payment of Gratuities Act. So, Payment of Gratuities Act, your employer is giving you gratuity in accordance with the Payment of Gratuities Act. Then, how do you compute the exemption? You pick the lower of these 3. Lower of these 3 shall be the exemption amount. And what is point number 1? That is 20 lakh statutory limit. You take 20 lakhs as statutory limit. And what is point number 2? Actual gratuity received. And what is point number 3? You take 15 by 26 into LDS, means last drawn salary, into completed year of service or part in excess of 6 months. What is part in excess of 6 months? Say if you have worked for 20 years and 8 months in a company, you can consider it as 21 years, because whatever fractional months you have that is in excess of 6 months have to be counted as one full year. So you can take 21 years. So 15 by 26 into last drawn salary. What is this last drawn salary? LDS means what, friends? Last drawn salary. That's the definition for the salary. That means last drawn basic salary plus Dearness allowance. That is the least, lower of these 3. So friends, very simple. You forget about this least. Okay. You take, what is the definition for the salary? Salary here means basic salary plus DA, whether forms part of retirement benefit or not, doesn't matter. You simply take the basic salary plus DA, whether it forms part of the retirement benefit or not. You take that last drawn salary into 15 by 26 into completed year of service or part thereof in excess of 6 months, and that will be your limit number 3. So simply it means, friends, if you are an employee who is in other category and you are covered under Payment of Gratuities Act, then how do you claim the exemption? You take either 20 lakhs as the statutory figure, or you take the actual gratuity received, or you take 15 by 26 into last drawn salary into completed year of service, or part thereof in excess of 6 months. You take the lower of these three, and the lower shall be the exemption in accordance with this respective provision. Now, not yet over. If you are a person not covered under Payment of Gratuities Act, say for example you are an employee and you are not covered under Payment of Gratuities Act, so let's understand how to compute the exemption. You take 20 lakhs as limit number 1, then you take actual gratuity received as limit number 2, then you take half into last 10 months average salary into completed year of service and ignore months. Simply means if you are a person not covered under Payment of Gratuities Act, you take 3 limits. 20 lakhs same, actual gratuity received same. Third limit is different. What is that? 1 by 2, half into last 10 months average salary. And what's the definition for salary over here? Salary have a separate definition over here. Simply means salary means basic plus DA forms part of the retirement benefit plus commission if it is expressed as a fixed percentage of the total turnover. That is the average salary over here. You take that salary, that same salary definition that we have seen under HRA. Okay, you take the basic salary plus DA forms part of the retirement benefit plus commission if it is expressed as a fixed percentage of your total turnover. You take that into 10. That means last 10 months divided by 10, because last 10 months average salary you have to take into completed year of service. So if you are a person not covered under Payment of Gratuities Act and you have worked for 20 years and 8 months, then what to do? Ignore the months because they are only saying completed year. So 20 years only you are supposed to take. So simply means, friends, listen, if you are an employee covered under Payment of Gratuities Act, you have to take the fractional months if it is 6 months or more. If you are a person not covered under Payment of Gratuities Act, always ignore the fractional months, only take the completed year. And what is the third formula? 1 by 2, half into last drawn, last 10 months average salary into completed year of service. And what is this last 10 months average salary? What is the salary over here? Basic salary plus DA forms part of the retirement benefit plus commission if it's expressed as a fixed percentage of your total turnover. And I hope this is clear. So the point is pretty simple, friends. Here, what they are saying, if you are a person being an employee who's in receipt of gratuity either at the time of retirement or your death, then you can claim the exemption. For claiming the exemption, you check whether you are a CG employee, defense service, local authority or civil servant. If yes, full exemption. Other employee, you check whether you are covered under Payment of Gratuities Act. If yes, 3 limits. What is the 3 limits? 20 lakh, actual gratuity, 15 by 26 into last drawn salary into completed year of service or part thereof in excess of 6 months. What's the next one? If you are not covered under Payment of Gratuities Act, then 3 limits. 20 lakh, actual gratuity receipt, or what is the third one? Half into last 10 months average salary plus average salary into completed year of service and ignore fractional months. And here, if you are not covered under Payment of Gratuities Act, there is one more twist is there. When you compute the last 10 months salary based on the last 10 months average salary immediately preceding the month of retirement. What do you mean by that? Say for example, if you are a person not covered under Payment of Gratuity Act and you are retiring on 31st October. You are retiring on 31st October 2024. Okay. If you are retiring on 31st October 2024, you will get the salary for the October as well. But while computing this 10 month salary, ignore that October. You take the past 10 months, excluding the month of retirement. That means you can take September, August, July, June, then May, April, March, Feb, Jan, like this 1, 2, 3, 4, 5, 6, 7, 8, 9 and December. This is how you have to take. You should ignore the month of retirement. That's what the department says. So I hope it is clear for you. So if you are a person who is not covered under Payment of Gratuities Act and you are claiming the exemption for the purpose, you are taking the salary because you have to consider 1 by 2 into last 10 months average salary. When you compute that last 10 months average salary, ignore the month of retirement. You exclude the month of retirement, then you take the past 10. Okay, you add that past 10 months salary, then divided by 10, you will get the last 10 months average salary. This is how you have to compute the exemption, or this is how you have to compute the salary for the purpose of exemption. So I hope it is clear for you. Okay friends, so the next topic that I want to discuss is pension. Next component of the chapter, salary. So what do you mean by pension? Say for example, an employee have worked and after his retirement, say his retirement age have come after his retirement, the employer will pay him a small monthly amount to, for the daily living of the employee. So the monthly sum received by the employee from the employer after the revision can be called as what? Pension. So pension can be divided into two, that is said to be commuted pension and uncommuted pension. Uncommuted pension simply means the monthly pension receivable by the employee from the employer, and it is fully taxable. There is absolutely nothing more. So if you are receiving monthly pension, that means uncommuted pension, then that uncommuted pension shall be fully taxable in the hands of employees. And how about commuted pension? And what do you mean by commutation? Commutation simply means an employee can go and take a lump sum amount rather than receiving monthly amount. Say for example, it's just like discounting a bill. Rather than receiving monthly pension, an employee can request and go for he can discount his pension and get a lump sum amount from the employer, and that concept is said to be what? Commutation of pension. So commutation is, say simply like, instead of monthly pension, the employee says, sir, I want my entire pension, that too in a go, by way of a lump sum amount. I require some lump sum money right now, so I don't want to receive this monthly pension, give me the full amount. That concept is said to be what? Commutation of pension. So if an employee commutes his pension, he is eligible for an exemption, and that's what we are about to discuss right now. So friends, listen carefully. Uncommuted pension, that means the monthly pension shall be fully taxable. There is absolutely no exemption for the uncommuted pension. In respect of monthly pension, the employee can claim an exemption. In respect of commuted pension, the employee can claim an exemption. That's what we are about to discuss right now. So if you are an employee of central government, local authority, statutory corporation, member of defense services, then the entire commuted pension shall be fully exempted. So if you are an employee, that means if you are a central government employee, or a local authority employee, or a statutory corporation employee, or a member of a defense services, then fully exempted. There is nothing taxable. And if you are other employees, say for example, you are a employee of a private limited company, and you are receiving this, you have commuted your pension, and how do you claim the exemption? That's what we are about to discuss. So if an employee are in receipt of gratuity, then exemption is as follows. If the employees are not in receipt of gratuity, then the exemption is as follows. So there are two ways to claim the exemption. So please listen. If you are a private limited company employee and you have commuted your pension, before claiming exemption, check whether the employee is in receipt of gratuity or not. If the employee is in receipt of gratuity, then how do you claim the exemption? Then the exemption shall be 1/3 of the 100% of the commuted pension. What do you mean by this? Say for example, I'll give you an example to make you understand this particular concept. Say for example, an employee, say Mr. JK is an employee of a respective company. He is in receipt of monthly pension. Okay, monthly pension, say 10,000 rupees. He is getting monthly pension 10,000 rupees. He retired on 1st January 2025 and is getting monthly pension of 10,000 rupees. On 1st March 2025, he retired. He commuted his pension. He commuted his pension. On 1st January 2025, he retired. And on 1st March 2025, he commuted his pension. He haven't commuted the entire pension. He only commuted, say, 50% of pension. He only commuted how much? 50% of the pension, and he received, say, rupees 5 lakh. He received rupees 5 lakh. When he commuted 50%, he received 5 lakh as the lump sum amount. Now, on March 2025, soon after the commutation, he will get monthly pension of rupees 5,000. How he will get monthly pension of rupees 5,000? Because he haven't commuted his entire pension. He commuted only 50% of the pension. So the respective remaining percentage on the monthly pension, he is eligible. So he only commuted 50% of the pension. So the balance 50% on the monthly pension, that is 5,000. From March, next April, till his death, he will receive monthly pension as well of rupees 5,000. Now, when he receives this 5 lakh rupees of lump sum amount, he can claim an exemption. How much is the exemption? If he is an employee who is in receipt of gratuity, then 1/3 of the 100% of the commuted pension. What do you mean by that? That doesn't mean it's 1/3 of 5 lakh is exempted. If he would have commuted his 100% of pension, what is the amount he would have received? On that amount, you apply 1/3. That simply means he commuted 50% and received 5 lakh. That means if he would have commuted 100% of pension, he would have received 10 lakh. The exemption shall be 1/3 of 100% of the commuted pension. That will be 1/3 of 10 lakh. He can claim 3,33,333 as the exemption, and the remaining amount of 177,777 shall be fully taxable. This is how you have to compute the exemption for commutation of pension. I hope it is clear. So friends, please listen, it is very simple. If you are an employee who have commuted the pension and you are in receipt of gratuity, then how do we compute the exemption for that respective employee? Very simple. You check whether the employee is in receipt of gratuity. If yes, then exemption shall be 1/3 of the pension that he would have received had he commuted his entire pension. Now, what if the employee is not in receipt of gratuity? If the employee is not in receipt of gratuity, then instead of 1/3, it would have half of 100% of the commuted pension shall be the exemption. What do you mean by that? Say for example, half of commuted pension, if you have commuted 100% of his pension, he would have received 10 lakh. Half of that will be the exemption, that means 5 lakh. So the entire 5 lakh he can claim as what? Exemption. That's what they are saying. So friends, the point is very simple. Pension. You can divide that pension into two. Number one, it is commuted pension, and number two, uncommuted pension. Uncommuted pension shall be fully taxable as and when you receive it. Commuted pension is pretty simple. Commuted pension, you check whether the employee is a central government employee or a local authority employee, statutory corporation employee, or member of defense service. If yes, fully exempted, nothing. You don't have to compute anything. If he is another type of employee, then you check whether the employee is in receipt of gratuity. If yes, 1/3 of the pension, if he would have received had he commuted his entire pension. If he is not in receipt of gratuity, then 1/2 of the pension had he received, if he would have computed his 100% of pension. This is how you have to compute the exemption. Soon after completing the theory, we will be discussing some important questions as well. So when we discuss the question, you will understand the remaining concepts. So this is another important component in the chapter salary. Moving on with the next component, that is said to be what? Provident fund. So friends, what do you mean by provident fund? Another retirement benefit given by the employer to the employee. And what do you mean by provident fund? It is just like a saving scheme. During your term of service, during your service period, both the employee and the employer will contribute. Employee will contribute from his own salary and the employer will contribute from his own pocket to the provident fund account. So both the employer as well as employee will contribute to the provident fund. In this provident fund, he will get interest as well. On retirement, the employee can withdraw the entire amount from the provident fund, including the interest. So he can make use of this lump sum amount for his after retirement life. The concept is said to be what? Provident fund, just like savings. During your period of service, both you and your employer have to contribute to that respective provident fund account. That provident fund account, you will receive interest. After your retirement, your entire money, including the interest and your contributions, you can withdraw and you can enjoy your life. This is the concept of provident fund. Now, provident fund, when the employer contributes something to the provident fund for the benefit of employee is getting a benefit. Yes or no? How do we compute that benefit and whether it is taxable or not? That's what we are about to discuss. So, let's understand what is the impact when you contribute something to a respective provident fund. For that, you should know there are 4 types of provident fund. Number 1, statutory provident fund. Statutory provident fund simply means provident fund which is maintained in accordance with the Provident Fund Act 1925. Provident Fund Act 1925. If you are maintaining a provident fund in accordance with the Provident Fund Act 1925, then you can call that respective fund as a statutory provident fund. Say for example, employees of university, railways, etc. are covered under statutory provident fund. Then second one is said to be recognized provident fund. That simply means an employer maintains his own provident fund and he is getting an approval from the Commissioner of Income Tax. You can call that respective provident fund as what? Recognized provident fund. You yourself is maintaining a provident fund and you get it recognized from a respective institution. Or rather, say an employee is maintaining a provident fund, the employer is maintaining a provident fund with any recognized institution like LIC or other institutions. So the employer is either maintaining a provident fund by himself and is getting an approval, or he is maintaining the provident fund with a recognized institution. Those provident funds are called as what? Recognized provident funds. In simple, we can say a provident fund which is recognized by the income tax department is said to be what? Recognized provident fund. Then another one. The next one is unrecognized provident fund. And what is unrecognized provident fund? Say for example, you are maintaining your own fund. An employer is maintaining your own fund and is not getting any recognition for that. Is not getting any approval from the income tax department for maintaining that respective provident fund. That respective fund, a private fund, we can say, without any recognition. That respective fund is called as unrecognized provident fund. And finally, there is one more thing that is called as public provident fund, PPF. That simply means, say, I'm a self-employed person. I don't have an employer, but I want to do the savings. So I can open my own provident fund account with any nationalized bank or a scheduled bank. Say for example, this SBI, ICICI, etc. You can open a provident fund account over there, and you will get some benefits in income tax as well. That's what we are about to discuss. So public provident fund means you yourself is opening a provident fund for your own benefit. There won't be any employer for you. So you are a self-employed person and you want to open a provident fund account for your savings purpose and all. That respective fund is said to be what? PPF, public provident fund. Any person can open that respective fund. So there are 4 types of provident funds and there are 4 treatments in income tax when you when your employer and yourself transfers any amount to the respective provident fund. Let's understand all the items one by one. So the first one is said to be statutory provident fund. Employer will contribute and employee will contribute and you will get interest as well. When the employer contributes something to a statutory provident fund, employer contribution is not taxable. It is fully exempted. The employer is contributing to the statutory provident fund for the benefit of employee, but nothing shall be taxable in the hands of employee. It is fully exempted. That is another advantage that can be enjoyed by the employee. So if your employer is contributing something to a statutory provident fund for your benefit, you are not supposed to pay any taxes for that respective contribution. It is fully exempted. How about your own contribution? When you contribute something out of your salary, you are receiving salary, out of that amount you are contributing something to a statutory provident fund. That amount contributed is eligible as a deduction under 80C under chapter 6A. So employee contribution eligible as deduction under 80C under chapter 6A. It's not under the head salary. When you compute the salary, you have to take the gross salary. After that, once you compute all the other head incomes, you club everything together and you compute the gross total income. From the gross total income under 80C, you can claim chapter 6A deduction. So friends, please listen. When the employee contributes something from his own salary to a statutory provident fund, he can claim that contributed amount as a deduction under 80C under chapter 6A. And finally, what will happen to the interest component? The interest, again, whatever the interest that you are getting from a statutory provident fund shall be fully exempted. You don't need to pay any taxes at all as per the Income Tax Act 1961. So the point is very simple, friends. Whenever your employer contributes something to a statutory provident fund, fully exempted. When you yourself is contributing something to a statutory provident fund, you can claim it as a deduction under 80C. When you are getting interest out of your own contribution as well as the employer contribution, that entire interest shall be fully exempted as well. So that is the treatment of statutory provident fund. Next one is recognized provident fund, and let's understand what is the treatment according with the Income Tax Act 1961. When the employer is contributing something to a recognized provident fund, you can claim an exemption, but that exemption is limited to 12% of the salary of the employee. You cannot claim any blind exemption. See, when your employer contributes something to a recognized provident fund for your benefit, you can claim an exemption. You are getting a benefit. You means employee is getting a benefit, but entire contribution shall not be taxable. Up to 12% of salary shall be exempted. Only the excess contribution shall be taxable in accordance with the Income Tax Act 1961. Now, what is the salary? What is the definition for salary here? 12% of salary. Here, salary means basic salary plus DA forms part of the retirement benefit plus commission if it is expressed as fixed percentage of your total turnover. So, the same salary definition that we have discussed earlier. That simply means here salary means basic salary plus Dearness allowance if forms part of the retirement benefit plus commission if it is expressed as a percentage of total turnover of employer. So the same thing that we have seen under HRI, the same salary definition is repeating here as well. So this is how you have to compute the exemption. Up to 12% of the salary shall be exempted. The remaining, if any, only shall be taxable. That's what the department say. Now moving on. Employee contribution. You yourself is contributing something to a recognized provident fund. You can claim it as a deduction under 80C under chapter 6A. If you yourself is contributing any amount to to this recognized provident fund, you can claim it as a deduction under 80C chapter 6A. How about the interest portion? Interest, you can claim an exemption, but there is a ceiling limit for that. That is 9.5% per annum. Interest up to 9.5% per annum. If you are getting excess interest over and above 9.5%, only that excess shall be taxable under the head salary. So friends, two things. We have discussed statutory provident fund as well as recognized provident fund. To the statutory provident fund, employer contribution no limit, full exemption. Employee contribution 80C deduction. Then interest no limit, fully exempted. To a recognized provident fund, employer contribution limit is there 12% of basic salary plus DA forms part of retirement benefit plus commission if it is expressed as a fixed percentage of your total turnover. Then employee contribution deductible under 80C, and interest 9.5% interest is exempted. Over and above you are getting some interest, that excess only shall be taxable under the head salary. Now, what is the third one? Third one is said to be what friends? It is said to be the unrecognized provident fund. That simply means employer himself opened some private fund and he's not he haven't got any recognition from any respective institution. Recognition from the income tax department. Though, so it's a kind of an unrecognized private fund. So if you are contributing to an unrecognized provident fund, let's understand what exactly is the effect of that. If the employer is contributing something, that employer contribution is not taxable. Why? Why? Because income tax department don't know that there is a private fund or there is an unrecognized fund. So whenever the employer contributes something to a unrecognized provident fund, there is no income tax impact on that respective contribution. Then you will think that it is better to always maintain a unrecognized provident fund. No, it's not like that. Because the taxability will come as and when you withdraw the amount from the respective unrecognized provident fund. See, to the recognized provident fund, when you withdraw the amount, you can claim an exemption under section 10 subsection 12. There is exemption. But from unrecognized provident fund, when you withdraw, entire withdrawal shall be fully taxable. Okay, so when you contribute, there is no taxability for the employer contribution to an unrecognized provident fund. How about employee contribution? Again, not deductible. Employee, when he contributes some amount from his salary to a unrecognized provident fund, department will not recognize it as a PF contribution, and hence nothing shall be deductible. And interest again not taxable. Everything will come when you withdraw the amount from that unrecognized provident fund. So treatment is simple. Unrecognized provident fund, employer contribution not taxable. Employee contribution not deductible. Interest not taxable. Very simple. And to the final item, and what is the final item friends? That is said to be the public provident fund, PPF. So in public provident fund, there is nothing called an employer contribution because normally it is opened by a self-employed person. So employee contribution eligible as a deduction under 80C, and the interest is fully exempted, not taxable as well. To a public provident fund, a self-employed person contributes something. The self-employed person can claim an exemption up to how much? Up to as per the limit prescribed under 80C, that is 1,50,000 in total. You can claim a deduction up to maximum 1,50,000, that is provided under chapter 6A 80C. And how about the interest portion? Interest again is not taxable. Whatever interest that you are getting from the public provident fund shall be fully exempted. You don't need to pay any taxes at all. So I hope the treatment to the respective provident fund is absolutely clear for you. There are 4 types of provident fund. Depends upon the type of provident fund, the taxability also varies. So I hope this much is clear for you. Now friends, we are about to discuss the next concept that is said to be perquisites. Another important component in this respective chapter is perquisites. So what do you mean by perquisites? Simply means friends, see, perquisite means a facility provided by the employer to the employee. Say for example, I will tell you the difference between perquisite and allowances. Say for example, house rent allowance is there and rent-free accommodation is there. What's the difference between house rent allowance and rent-free accommodation? Say for example, house rent allowance is an allowance. Every month the employer will give you a fixed monthly amount. Whether or not you are paying rent, whether or not you are utilizing that respective allowance, employer will give you a fixed monthly amount always. He will never check what exactly is your actual expenditure. That is said to be HRA, house rent allowance. So allowances are always fixed monthly sum. It will not have a direct nexus with the expenditure of the employee. Second one, perquisite. Rent-free accommodation is given as a perquisite. What is rent-free accommodation? Either the employer will give a house to the employee or the employer will take care of the actual rent of the employee. If the actual rent is taken care by the employer, we can say it as a perquisite, a facility provided by the employer. So there is a difference between perquisite and allowances. Allowance simply means a fixed monthly amount. Perquisite means either the facility will be provided by the employer or he will take care of the expenses of the actual facility. That is said to be what? Perquisites. Now we are about to discuss different perquisites, and let's understand how to value these perquisites in accordance with the Income Tax Act 1961. So friends, moving on with the first item, that is medical facilities. What do you mean by medical facility? Say for example, an employee have incurred some medical expenditure. Employee had some medical issues. He incurred some medical expenditure. His employer reimbursed that medical expenditure. His employer reimbursed that respective medical expenditure. So employee is getting a benefit. Yes or no? That benefit, whether you need to pay taxes for that benefit according to the salary head or not, that's what we are about to discuss first. So the medical facilities. Value of medical treatment incurred by the employer. And this medical treatment is either incurred for yourself, that means for the employee, or for the family members. Family member means your spouse and children, then your dependent father, mother, brother and sister. So the medical expenditure is incurred either for the employee himself or for the family dependent. What do you mean by family member or family dependent? Family member means spouse and children. Family dependent means your parents, brothers, sisters, if they are dependent on you. That means if they are financially dependent on you, you have to consider them also as a family member. So the point what they are saying is, in this situation, whatever medical facilities provided by the employer, for the employee as well as for the family member shall be fully exempted. So that's what we are about to discuss. So in the following situations which we are about to discuss, all the medical facilities provided by the employer for the medical treatment of the employee as well as for the family members shall be fully exempted. And let's understand which all are the exempted categories, so that whatever else comes in shall be fully taxable. So which all are the exempted items? Number one, if hospital owned by the employer. So the employer himself have a hospital. So he is giving free treatment for the employee. All the employees of the respective company can enjoy a free treatment from that respective hospital. So the employer provides free treatment from his own hospital. Nothing shall be taxable in the hands of employee, even though the employee is getting a personal benefit, because you don't have to spend any penny for the medical treatment of himself or for his family members. But still, department say nothing shall be taxable. It is fully exempted. Second one, if the hospital owned by government or local authority, LA means local authority, or approved by government. So in government hospital, the employee have undergone a treatment and the employer reimbursed that entire amount. Nothing shall be taxable in the hands of employee. Now, next one, expenses for prescribed diseases including COVID-19 in hospital approved by Principal Chief Commissioner or Chief Commissioner. PCC means Principal Chief Commissioner. CC means Chief Commissioner. So, for example, employee have some prescribed diseases, COVID-19, kidney diseases, tuber, cancer, etc. He have some prescribed diseases, and for that disease, he undergone a treatment in an approved hospital. Approved hospital means approved by the income tax department. Then, in such a case, whatever the treatment expenditure comes in, it shall be fully exempted, even if it is completely sponsored by the employer. So, three things: full exemption in a hospital owned by the employer. Number two, in a hospital owned by the government, local authority or approved by the government. Number three, for prescribed diseases in a hospital which is approved by the income tax department. In all these three cases, full medical expenditure reimbursed by the employer or incurred by the employer, whatever it is, shall be fully exempted, provided the medical treatment is for the employee or for his member of his household. Now, there is one more item, that is health insurance premium paid, provided it is an IRDA approved insurance. Say for example, the employee have a health insurance and the premium is actually taken care by the employer. Employee have a health insurance and the employer pays the premium. Employee is getting a benefit, but nothing shall be taxable, provided that insurance policy have to be approved by IRDA, Insurance Regulatory Development Authority. Every insurance in India, if you want to run an insurance company, you have to get an approval from IRDA. You cannot simply open a space for running an insurance company without the approval. It is impossible. So in exam question, if they are saying health insurance paid by the employer, it is obvious that it should be approved by the IRDA. But in the question, if they are saying it is not approved by IRDA, then you will not get the benefit of exemption fully. It will be fully taxable. Then, and what is the final point? There is a foreign medical treatment. That simply means the employee is planning to undergo treatment in a foreign country. He don't want the treatment in India. He is planning to go abroad and to complete his treatment. In such a case, treatment cost will come. Then cost of stay abroad will come and cost of travel also will come. The entire treatment cost, cost of stay abroad and traveling cost, everything is sponsored by the employer. In such a case, what is taxable and what is exempted? Let's understand. Say for example, for foreign medical treatment, entire treatment cost as well as the cost of stay abroad for the patient as well as for one attendant. What is one attendant? The employee took his wife as well, because it's in a foreign country. It will not be practical for himself to go over there and complete the treatment. So he took one attendant. It can be a relative or it can be a friend or whoever it is. So whatever the cost of stay abroad for the patient as well as for one attendant shall be fully exempted, even if it is reimbursed by the employer. And the final case, cost of travel abroad, your traveling cost for the patient as well as for one attendant is exempted provided the employee's gross total income is less than 2 lakh. That simply means if the employee's gross total income is less than 2 lakh, less than or equal to 2 lakh, then you can claim the exemption for that respective foreign travel as well. So these are the exempted category and maximum exemption to the extent permitted by Reserve Bank of India. Say for example, in examination question they may say treatment cost incurred is say 70 lakhs, 70,000. Treatment cost is 70,000. Stay abroad, say 15,000. Then travel abroad, say another 15,000. So all together, say it is 1 lakh. That is the total cost incurred by the employer. All right. Now, but in the examination question, say RBI permitted only 80,000. RBI permitted only 80,000. If they are saying like this, then the maximum exemption shall be 80,000 and the remaining 20,000 shall be taxable as perquisite in the hands of employee. So hope you remember this. You have to remember this. Okay. So the treatment cost abroad, cost of stay abroad of the patient plus one attendant plus cost of travel abroad of patient plus one attendant. And then for claiming the exemption for this travel abroad, employees gross total income should be less than or equal to 2 lakh. If we want, you take the total of all these three, then the entire amount is not always fully exempted. It is exempted provided that entire amount is permitted by Reserve Bank of India. So maximum exemption to the extent permitted by RBI. If the RBI is permitting only a lower amount, that lower amount is only exempted. The remaining shall be taxable as well. So I hope you got my point. Now, in any other case, if the employer is reimbursing or incurring any cost, then it shall be fully taxable. Say simply it means, say for a normal disease, employee is undergoing a treatment in a private hospital and the employer reimburses that entire amount, fully taxable in the hands of employee. Whatever amount reimbursed by the employer shall be fully taxable in the hands of employee, and that's what the department says. So I hope that medical facility is also clear for you. Now, so moving on to the next component, that is said to be what, friends? Leave travel concession, which is under section 10 subsection 5. So let's understand what exactly is this leave travel concession right now. So friends, please listen. Say, I am an employee of your company, you are my employer and I am your employee, okay? And I am planning to go for a tour or a trip in India. I've gone for a trip in India. I'll incur traveling cost. Then food and accommodation also will come. The entire cost is reimbursed by you. You have reimbursed the entire amount, including the traveling amount, food and accommodation, and every other penny you have taken care of. Now my question is, am I getting any benefit? Yes. You being my employer have sponsored my tour within India. Yes or no? So whatever amount sponsored by you shall be a benefit received by me and it should be taxable. But department say, in accordance with 10 subsection 5, you can claim an exemption for the traveling cost alone. You can claim an exemption for the traveling cost reimbursed by the employer, and that exemption is not a blind exemption. It is subjected to the limits prescribed under 10 subsection 5. So leave travel concession simply means if the employee is going for a trip and the trip cost is suffered by the employer or reimbursed by the employer, then the employee can claim an exemption for the traveling component in that entire amount sponsored by the employer. And let's understand how do we compute this and which all are the conditions and what all are the limits applicable over here. So we'll start with the first point. Exemption can be claimed for traveling expenses incurred by the employer. So the employer, if he reimburses the traveling expenses, you can claim an exemption subject to the limit. Food and accommodation and the other expenses shall be always taxable. You are not eligible for any exemption for the food and accommodation expenses. Second one, employee can perform 2 journeys in India in a fixed block of 4 calendar years and claim exemption for the traveling cost incurred by the employer. You cannot perform n number of journeys and you cannot perform the traveling cost of n number of journeys which is sponsored by your employer. It is not possible. Rather, what department say, in a block of 4 calendar year, maximum you can perform how many journeys? You can perform maximum 2 journeys and claim exemption for the traveling cost of those 2 journeys only. If you have performed 4 journeys, then out of 4, only exemption is eligible for 2 journeys only. That too, that travel have to happen within India. If you are going abroad, you are not eligible for any exemption. That full traveling cost shall be fully taxable. So, employee can perform 2 journeys in India in a fixed block of 4 calendar years and claim exemption for the traveling cost incurred by the employer. And what is this fixed block? What do you mean by the fixed block of 4 calendar years? It simply means the block is fixed. Say for example, your relevant previous year for your upcoming examination is 2024-25. Say for example, and your block will be from 1st April 2022, it ends with 31st December 2025. Say for example, I've joined in a company on 1st April 2024. I've joined in a company on 1st April 2024. That doesn't mean that my block will start from 1st April 2024 and my block is for the next 4 years. It is not like that. Irrespective of my date of joining, I'll enter to this respective block. If I'm joining the company on 1st April 2024, I'll fall to the 22-25 block, 4 calendar year block, 22, 23, 24, 25. In that block, I can perform a journey up to 2 journeys and I can claim exemption for the traveling cost. That's what they are saying. That is said to be the fixed block. It starts from 1986. 86-89 is the first block, 1993 second block, 94-97, 98-2001, 2002-2005, 6-9, 10-13, 14-17, 18-21, 22-25 is the relevant block. That means your previous year will be 24-25, then your relevant block will be 22-25 and the upcoming block for the upcoming attempts will be 25, 26, 29, not 25, 26, 29. Now, so you can perform in a calendar year of 4 calendar years. Respective block will always consist of 4 calendar years. In that respective block, you can perform 2 journeys and you can claim the traveling cost as an exemption. Now, if an employee is not claiming exemption in a block, then one such unavailed benefit can be carried forward to the next block and claim exemption for 3 journeys. Say for example, in 22-25, I haven't performed any journey. I could have performed 2 journeys, but I haven't performed any. So out of this 2, 1 journey I can carry forward to the next block, 26-29 block. So listen friends, be careful. If you haven't performed any, out of those 2 unperformed journeys, you can carry forward 1 to the next year. That means to the next block. That means in the next block, you can go for 3 journeys and claim exemption for the traveling cost of all the 3 as well. Now, in 20-25 block, I have performed 1 journey and 1 journey is pending. I've only performed 1 journey and claimed exemption and 1 is pending. Can I carry forward this 1 pending to the next year? No. If both are not performed, out of those 2 unperformed, I can carry forward 1 and I can claim 3 in the next year. In the next block also, 3 journeys are there. I haven't performed any. Then out of those 3, only 1 again can be carried forward to the upcoming block period. So that's what the department said. So in a block period, if I haven't performed any, then out of those unperformed 2, I can carry forward 1 to the next block. That's what the department says. Now, when you are going for a journey, can you take your family members? Yes, you can definitely take your family members. So you being the employee, you can definitely go. Your traveling cost reimbursed by the employer is definitely exempted. Your wife, children, then dependent parents, brothers and sisters, they also can accompany, and their cost also you will get an exemption. There is absolutely no problem, but there is a small problem with the children. Why they are saying is, for children there are certain restrictions. If you are taking children, restriction for the number of children is there. If you have children which is born before 1st October 1998, then absolutely no restriction. If your children is born on or after 1st October 1998, then exemption can be claimed only for 2 children born after 1st October 1998. That simply means, say for example, you are Mr. A and you have 8 children. Okay, you have 8 children. And out of this 8, 5 children born before 1st October 1998 and 3 children born on or after 1st October 1998. Okay, so in such a case, for this 5 children, you can take all those 5 and you can claim the traveling cost of all those 5 as an exemption. Absolutely no problem. And how about this 3? Out of this 3, only 2 children's traveling cost you can claim exemption, because there is a restriction for the number of children that you can accommodate which is born after 1st October 1998. So if you have children which is born after 1st October 1998, how many children you have out of all of them whose birthday is on or after 1st October 1998, out of all of them you can claim exemption only for the traveling cost of 2 children. Now there is one more benefit is there. What is that benefit? Multiple birth after the first child shall be considered as 2 only and can claim exemption for all. Say out of these 3, you have 1 child. After that you have twins. Then you can take all of them and claim the exemption for 3 of them. No problem. After the first birth, if the children is born after 1st October 1998, after the first birth you have multiple, then no problem. Say instead of twins, say it is triplets, no problem. You can take all those 4 and claim exemption for the traveling cost. However, there is another thing. After 1st October 1998, the firstborn is twins. Thereafter, you have 1 child. Then this is counted as 3 only. Then you can claim only traveling cost of 2 children. That's it. After the first birth, if it is multiple, no problem. You can take all of them and claim the traveling cost of everyone as an exemption. That's what the department says. Now you will ask me, sir, so we have followed all the conditions till now. Can we claim the entire traveling cost and exemption? The answer is again no. You cannot claim the entire traveling cost as an exemption. Then how do you claim the exemption? Maximum exemption shall be as follows, friends. So let's understand what exactly is the maximum exemption. If the journey performed by air, so you have, say for example, you are Mr. A, say from Chennai, you have went to Delhi. Okay, from Chennai, you visited Delhi. So you have performed it through flight. You took flight for this. If you took flight for this, then what the maximum exemption is the economy class air ticket fare. So you have traveled in business class. Can you claim that entire business class ticket cost as an exemption? The answer is a big no. You cannot claim the entire business class ticket cost as an exemption. Not possible. The maximum exemption shall be what, friends? Maximum exemption shall be the economy ticket fare of that respective Chennai, Delhi flight. Like that's what the department say. Now, if you have performed the journey in any other mode, say you have actually went for a road trip in your car, you performed the journey in that respective in your car from Chennai to Delhi, you drove. Okay, in such a case, you have to check whether then you cannot claim that entire petrol cost as an expenditure exemption. Okay, not possible. Then what you need to do, you need to note down, write down, say for example, and it took 50,000 rupees for you. Fuel charges was 50,000 rupees. You note down that 50,000 rupees reimbursed by the employer. Then the maximum exemption shall be, you need to check whether Chennai and Delhi have a rail service. If the answer is yes, maximum exemption shall be the first class AC ticket fare of that respective Chennai Delhi train. So Chennai Delhi train is costing say 10,000 rupees as a ticket fare. So you can claim maximum exemption as 10,000 and the remaining 40,000 shall be taxable. So if you are performing the journey not in flight in any other mode, then you need to check whether your destination and place of origin and destination is covered by rail. If yes, then the maximum exemption shall be the first class AC fare of that respective train ticket, not more than that. And what if your place of origin and destination is not covered by train? Say there is no direct rail train from Chennai to Delhi. In such a case, what you need to do? You need to check whether recognized public transport system exists. You need to check whether there is any recognized public transport system from Chennai to Delhi. If the answer is yes, maximum exemption shall be the first class ticket fare of that recognized public transport system. Say there is approved bus, not private lorry and all, approved bus. It's a bus route. Then you can take the best ticket cost as the maximum exemption. And you have performed the journey in any other mode. and you don't have a rail service, that place of origin and destination is not covered by train, and there is no recognized public transport system as well. There is no recognized public transport system as well. Then how much is the maximum exemption? Amount equivalent to the first class AC fare of the rail as if the journey had been performed by the rail. How do you claim this? Say for example, you have performed in car. Your place of origin and destination is not covered by rail. There is no public transport system as well. Now the question is, how do you find out the first class AC fare of rail as if it is performed by train? Because there is no train connection between between Chennai and Delhi. In such a case, how do you claim this amount? That amount will be given in the question first of all. In examination, you don't have to compute this. Practically what we do is, we will find out the ticket cost of the nearest railway station. Wherever is the nearest railway station, we will compute the ticket cost of that respective train ticket and we claim it as an exemption. In examination, you don't have to worry about this because if this information will be provided in the question itself. So, the maximum exemption amount shall be the first class AC fare of the rail as if the journey have been performed by rail. This is what the department says. So, I hope it is clear. And one more thing is there, if multiple destinations are there, then place of origin to the farthest destination, that to the shortest route. That simply means you are going to multiple places. Say from Chennai, you have visited Bangalore. Then from Bangalore, you visited Hyderabad. Then from Hyderabad, you visited Delhi. Then from Delhi, you came back to Chennai. So in such a case, how do you claim the exemption? Maximum exemption shall be from Chennai to Delhi and back. Whatever is the traveling cost from Chennai directly to Delhi and getting back, that shall be the maximum exemption. That's what the department say. So if multiple destinations are there, then place of origin to the farthest destination, that to shortest route is the maximum exemption that you can claim. So I hope that point is also clear. So this is what is called as 10 subsection 5 leave travel concession. So I hope it is super clear for all of you. So friends, moving on with the next concept, that is said to be what? Rent-free accommodation. Let's understand what is this rent-free accommodation. Okay, so say for example, the employer owns a house. Okay, owns a house and it has been given to the employee for free. So the employee can live over there without paying any rent and the employee is getting a benefit. And let's understand how to value that benefit, because for providing this house, you cannot claim any exemption. But right now what we are about to discuss is how do you value that particular perquisite, because due to your employer-employee relationship, the employee is getting a benefit. So how do you value that respective benefit? That is the next important component, which is a frequently asked component that we have to discuss in detail. So we can divide this accommodation into two, that is unfurnished accommodation and the second one is furnished accommodation. What is unfurnished accommodation? Only the house is provided, there is no washing machine, TV, fridge, etc, etc. And what will be furnished accommodation? Along with the home, the employer is giving washing machine, TV, fridge, etc. And let's understand how do we value unfurnished accommodation first. Once we complete unfurnished accommodation, we will move on to the furnished accommodation. So if the employer is giving a unfurnished accommodation to the employee, then you have to check whether the employee is a government employee. If the employee is a government employee, then for every house given by the government, there will be a license fees determined by the government. So every house, the government will have a base price, base value, that is said to be the license fees, and that will be given in the question. So that license fee is determined by the government minus, this will be an annual fee. This will be like an annual fee. From that you can deduct the amount collected from the employee. So the annual fees is 1 lakh and the employee pays 60,000 rupees every year for that respective accommodation. So the taxable value shall be 40,000. So this is how you have to value if you are a government employee. And tell me friends, what if you are a non-government employee? Say you are a private company employee and your employer gives you a house and the house is owned by the employer, then how do you value that respective perquisite? Nothing shall be exempted, it is fully taxable, but you should know how to value the perquisite. So if the employer owns a house and that respective house is given to the employee without any rent, then what you need to do is you need to check the population of the city where the house is situated. If the population of the city where the house is situated is more than 40 lakhs, then your value, you have to value 10% of the salary as the perquisite valuation, which is taxable in the hands of employee. So please listen friends, if the house is owned by the employer and it has been given to the employee and the house is situated in a city where the population as per the preceding census is more than 40 lakhs, then what you need to do? You need to take 10% of the salary of that respective employee. In certain questions, they haven't given the population of that respective city. If the population of a respective city is not given in the question, then what do? You need to assume the population. Say for example, cities like Chennai, Hyderabad, Mumbai, Kochi, etc. If the city is familiar for you and they haven't mentioned the population, then you can assume the population has more than 40 lakhs. Otherwise, they have to give the population in the question. So students are not supposed to by heart all the populations of all the famous cities in India. It's not practical as well. So if the population of the city is not given in the question, then you write your assumption. Assume it is more than 40 lakhs if it is a famous city. If it is the city is not a kind of a famous city, then you can assume otherwise as well. So the population of the city is more than 40 lakhs. Then how do you value 10% of the salary? Minus any amount collected from the employee also you can deduct. Only the net amount will be taxable as the perquisite. Now what do you mean by salary here? Salary does have a definition over here. Here the salary means basic salary, the DA forms part of the retirement benefit, all the taxable allowances, bonus, commission, etc. So basic salary, DA, taxable allowances, bonus, commission, etc. shall form part of the salary, but it excludes perquisites. Don't add perquisites while computing this respective salary, and excludes employer contribution to recognized provident fund. If the employer is contributing excess to a recognized provident fund, that is 12% is the maximum exemption. If excess contributions are there, that will form part of the taxable salary, but that will not form part of the salary for the purpose of computing this rent-free accommodation. So I hope that point is clear. So very simple, if the house is situated in a city where the population is more than 40 lakhs, then how do you compute the exemption, friends? Sorry, how do you compute the perquisite value, friends? Very simple, you take 10% of the annual salary for valuing that perquisite annually. Then you can deduct the actual recoveries from the employee. And what if the population of the city is less than or equal to 40 lakhs? There is equal to also here. Less than or equal to 40 lakhs, but it is more than 15 lakhs. The population of the city is more than 15, but less than or equal to 40 lakhs. Then instead of 10%, it is 7.5% of the salary. Salary does have the same definition. Minus amount collected from the employee. What if the population of the city is less than or equal to 15 lakhs? Then 5% of the salary minus amount collected from the employees shall be the taxable value of perquisite. So either in the question they will give the population of the city, or rather you can assume the population of that respective city. Now this alternative is there if the house is owned by the employer. And what if the house is taken on rent by the employer? The employer have taken a house on rent and given that respective house to the employee. In such a case, you have to value like this. Either 10% of the annual salary of the employee or actual rent, whichever is lower. If the house is taken on rent, either you take 10% of the salary or actual rent, whichever is lower. Then from that you can deduct the amount collected from the employee. From that you can deduct the amount collected from the employee, and this is how you have to value rent-free accommodations in accordance with the Income Tax Act 1961. Now friends, in the furnished accommodation, so right now we have valued unfurnished accommodation. Say the value of unfurnished accommodation, UFA means unfurnished accommodation, is say 10 lakhs. Along with the value, you need to add the value of furniture if it is a furnished accommodation. So find out the value of unfurnished accommodation. Along with that, you add 10% of the actual cost of the furniture if it is owned by the employer. If it is taken on rent by the employer, then you add the rental charges. Say for example, in this respective house, there is a TV worth rupees 1 lakh, costed rupees 1 lakh for the employer, and you have used it for 1 year. Then you add 10% for every year. 1 lakh into 10% will be 10,000. And there is one AC which is taken on rent by the employer, and the 40,000 is the annual rent. Then you add that 40,000 annual rent as well. So 10 lakh plus 10,000 plus 40,000, your total perquisite shall be 10 lakh 50,000. This is how you have to value. So in the case, if the house is a furnished accommodation, first you value unfurnished accommodation, then you add the value of the furniture. If the furniture is owned by the employer and given to the employee, then for an annual, 10% of the original cost of the employer is the annual value of the furniture. If the furniture is taken on rent by the employer, then nothing to worry. You take the annual rental charges suffered by the employer for the purpose of computing the perquisite. I hope that point is also clear for you. Now, there is one more note is there. What is that, friends? Accommodation owned by the employer or leased by the employer. The same is given in the upcoming years as well. Like year 2, 3, etc. Year 2 value shall be year 1 value into 363 by 331 or value as above chart, whichever is lower. So it is the latest statutory amendment came in. Say for example, this is basically with effect from 2023-24. I'll explain this by way of an example. Say in 2023-24, annual salary of the employee was say 10 lakhs. Okay, and the house was owned by the employer. employer, and it is in Mumbai. It is in a metro city, say Mumbai. Annual value was 10 lakhs. So how do you value annual value? You need to value at 10% as the taxable perquisite. So the taxable perquisite for 23-24 is say 1 lakh. Say the employee got a salary hike in 24-25. Next year the employee got a salary hike and the salary become 15 lakhs. Salary become how much, friends? 15 lakhs. Then 10% of the salary means 1,50,000. 10% of the salary is 1,50,000. In such cases, year 1 will be always 23-24 because this is with effect from 23-24 only. So 23-24 the perk value was 1 lakh. In the second year 24-25 it become 1,50,000 on account of hike in the salary. In such a case, what you need to do, rather than simply writing 1,50,000 as the perk value, what you can do is you take the perquisite value for the year 23-24 1 lakh. Then you index it. Index number for 24-25 is 363 and the index number for 23-24 is 331. You need to index that rupees 1 lakh. Index means you need to apply the index numbers for 24-25 as well as index numbers for 23-24. So 1 lakh into 363 divided by 331, it will be 1,09,667. So index number will be 1,09,668. We can round it off. So 1,09,668 or 1,50,000. That means year 2 salary into 10%, whichever is lower. So you have to value only at 1,09,668 in such case. So you are an employee who got a job in 23-24 and you valued your perk according to 10% or whatever the value is. And in the next year, if there is a salary hike and the 10% is more than the indexed value of the perk, in such a case, you have to apply lower of these two. This is what the department say. So the accommodation owned by the employer or leased by the employer, same is given in the upcoming year as well, like year 2, 3, etc. Then year 2 value shall be year 1's value, maximum year 2's value shall be year 1 value into 363 by 331 or value as per the above chart. That means the original valuation method, whichever is lower you can take. So either 1,09,668 or 1,50,000, whichever is lower you have to apply. I hope you got my point, and this is how you have to value the rent-free accommodation. Alright friends, so moving on with the next perquisite valuation. Next is valuation of domestic servant. Say for example, the employer have provided a domestic servant to the employee and you are making use of the service of the domestic servant and the employer pays the salary of the domestic servant. Then how do you value the perquisite? Because employee is getting a benefit. How do we value the perquisite? That's what we are about to discuss. So if servants are employed by the employer, that means employer have appointed a servant and that employer have given that respective servant to the employee. In such case, taxable in the hands of specified employees only. So that will be a taxable perquisite provided the employee is a specified employee. And what is the specified employee? That I will tell you later. So for the time being, if the servants are appointed by the employer and it has been given to the employee, then it will be taxable in the hands of employee only if the employee is a specified employee. And how do you value it? Very simple. The salary paid by the employer to the respective domestic servant, that salary shall be the value of taxable perquisite. And what is domestic servant? Your housemate. Now, if servants are employed by the employee himself, so the employee himself have appointed a servant and that respective salary has been reimbursed or directly paid by the employer, that will be taxable in the hands of all the employees. First of all, let's understand what exactly is the concept of specified employees. So let's go to the definition of specified employees and come back. Okay, so let's understand what exactly is the definition of specified employees. So specified employees simply means three types of employees are normally considered as specified employees. Number one, a employee who is also a director of the company. So you are a director employee of the company, you will be considered as a specified employee. Number two, employee having substantial interest in that entity. Substantial interest means 20% or more voting power in a company or 20% or more stake in a particular entity. So if you are a person, say for example, I am an employee of a company and I have 22% shares in that respective company, I'll be considered as an employee with substantial interest. And I also will be considered as a specified employee for the purpose of income tax. And the third one, employees drawing annual salary of more than 50,000. Fantastic. How much? Annual salary more than 50,000. So in practically in a company, 99% of the employees are what? specified employees only. But in examination question, they may say the employee is a specified employee or they may say the employee is a non-specified employee. So the point is very simple. Domestic servant appointed by the employer, given to the employee, and the employee, if he or she is a specified employee only, it will be taxable. Otherwise, it will not be taxable. If the domestic servants are appointed by the employee himself and he asks for the salary from the employer and the employer gives the salary to the domestic servant, in such a case, it will be taxable in the hands of all employees. So there is a shortcut to learn all this. In the case of specified employee, non-specified employee, what you need to do is domestic servant is number one. Say, for example, domestic servant is owned by the employer, given to the employee. Owned by the employer and given to the employee, it will be taxable in the hands of specified employee only. Owned by the employee and the salary is reimbursed by the employer, in such a case, it will be taxable in the hands of all employees. So that is the shortcut. Appointed by the employer and given to the employee, taxable only if it is a specified employee. Appointed by the employee himself and asked for the salary from the employer or reimbursed by the employer, then it will be taxable in the hands of all employees as well. And that's how you should remember that. This theory will actually help you to remember that particular concept. Moving on to the next one, friends, item number 4, that is gas, electricity, water, etc. supplied by the employer. So the employer is giving free gas or free electricity or free water to the employee. How do we value the perquisite? Let's understand. If supplied by the employer, then taxable in the hands of specified employees only. That simply means, say for example, the gas connection or electricity connection or water connection is in the name of employer and given to the employee, then it will be taxable only in the hands of specified employee. If the connection is in the name of the employee and reimbursed by the employer, then it will be taxable in the hands of all employees. If the connection is in the name of the employee and reimbursed by the employer, then it will be taxable in the hands of all employees. Now let's understand the valuation. Manufacturing cost per unit if owned by the employer. Say for example, the employer is actually a gas agency. The employer is giving free gas to one of its employees. Then whatever be the manufacturing cost of respective gas per unit shall be the taxable value of perquisite in the hands of employee. And if that is not owned by the employer, then actual cost paid by the employer. Say for example, say the employer is getting a gas, buying the gas, paying some amount to an external gas agency and giving this gas for free to the employee, then whatever the amount paid by the employer to the gas agency shall be the taxable value of perquisite in the hands of employee. From this also, you can definitely deduct whatever the recoveries from the employee also you can deduct, and that's what the department says. So this is how you have to value gas, electricity, water, etc. supplied by the employer. So I hope that point is also clear for you. Moving on to the next one, friends, training, refresher course, etc. given by the employer to the employee. Say for example, the employer have given some free training for increasing the skill of the employee. So even though the employee is getting a benefit, it is predominantly for the official purpose only and hence not a taxable perquisite and no personal benefit for the employee. If the employer is giving some personality development classes or some marketing skill classes, especially to the people in marketing, if the employer is providing some training sessions to the employees, whatever the cost incurred by the employer shall not be taxable in the hands of employee. So it is not considered as a personal exclusive benefit. It is most predominantly for the official purpose only. So nothing shall be taxable in the hands of employee. Next one is gift. Gift, if employer gives any gift to the employee and the value of the gift exceeds 5,000, only the excess shall be taxable. Say for example, the employee conducted a birthday party. The employer gives a gift of worth 7,000, a gold ring of worth 7,000. 2,000 shall be taxable in the hands of employee. So if the employer is giving a gift to the employee, whatever the value of the gift, if it is excess 5,000, only that excess shall be taxable in the hands of employee. And if the employer is giving cash, say the employer is giving 3,000 rupees to the employee, then you will not get the benefit of 5,000. If it is a cash gift, fully taxable. If it is not cash gift, like gold ring or some kind of valuables they are giving, up to 5,000 is exempted, only the excess shall be taxable. If cash gifts are given, then entire cash gift shall be always fully taxable, and that's what the department says. If employee is getting some gifts from his friends, then nothing shall be taxable under the head salary. It may taxable under IFOS, that we will cover under IFOS. So gift from the employer to the employee, and the value of the gift, if it is in excess of 5,000, then only that portion which is excess over and above 5,000 shall be taxable in the hands of employee. Cash gifts, you will not get the benefit of this 5,000 as well. I hope this much is clear for you. So moving on to the next one, next is valuation of motor car. So let's understand how do we value the motor car. So friends, please listen. Say for example, if the employer have a motor car and that car is given to the employee, let's understand how to value the benefit in the hands of employee. So let's understand, say the car owned by the employee and running and maintenance charges met by the employee, nothing shall be taxable perquisite because say I am the employee and you are my employer. I have a car and running and maintenance charges, fuel and other expenses are met by me. So I am not getting any benefit from you. So nothing shall be taxable in my hands as perquisite. So I own a car and the running and maintenance charges are met by the employer. You are sponsoring the fuel and other repair and maintenance cost. I own a car, you are sponsoring the fuel and other maintenance cost, and I'm using that respective car for official purpose. Nothing shall be taxable perquisite because I'm not getting any personal benefit. So I have a car, you are paying the fuel and other expenses, and I'm using that car for official purpose. So I'm not getting any personal benefit. So nothing shall be taxable perquisite. Number two, I have a car, running and maintenance charges met by the employer, and I'm using it for my personal benefit. Now I'm getting a personal benefit over here because I'm using it for my personal purpose. Then the actual running and maintenance charges met by the employer shall be taxable in my hands because I have a car, I have to fuel it. If you are fueling it, you being my employer, if you are fueling it, then I'm using that car for my personal purpose and you are fueling it. That means what? Indirectly, you are sponsoring my personal trips and the value of the fuel that met by you shall be the taxable perquisite in my hand. Now the problem is, if the car is used for official as well as personal purpose, I'm using it for official as well as personal purpose. At times I go for personal trips and at times I go for official trips. And the entire fuel and other maintenance expenses are met by the employer. In such a case, it is not practical for the employee to record the kilometer, whether it is travel for official or whether it is travel for personal. To note down the kilometer for each and every trip is not practical. So what the department say, you do one thing, you check whether the cubic capacity of the car is less than or equal to 1.6 liters. 1.6 liters means 1600 cc, less than or equal to 1600 cc or not. Then what you need to do is, say for example, a Maruti Suzuki Swift is given by the owned by the employee and the maintenance and running charges are met by the employer and the car is used for official as well as personal purpose. Then what to do? In such a case, because Maruti Suzuki Swift's cubic capacity is less than 1.6 liters. So in such a case, what we need to do is, you need to note down the actual running and maintenance charges. Okay, the entire running and maintenance charges is not taxable as perquisite. So what you can do is, you can deduct 1800 rupees per month. And if driver is there, you can deduct additional 900 per month. If driver is also there, then whatever the remaining figure, that shall be the taxable perquisite. So the point is very simple, friends. Listen, say, if I own a car and you are meeting the maintenance and running expenses and I'm using it for my official as well as for personal purpose, and the car's cubic capacity is less than or equal to 1.6 liters, then what I need to do is, I have to note down the entire running and maintenance charges. From that, I need to deduct 1800 per month. If driver is also there, I need to deduct additional 900 per month. So the remaining shall be the taxable value of perquisite. For example, I own a Maruti Suzuki Swift and the maintenance and running charges met by my employer and the entire maintenance and running charges for a year is 1 lakh. Then how do we compute the taxable value of perquisite? For the entire year, 1800 into 12 months. I have to deduct. So how much is 1800 into 12 months I have to deduct? That means, let's compute the value, friends. So 1800 into 12, that will be 23,400 I have to deduct. Then driver is also there, then 900 into 12. So 900 into 12, that will be 10,800. The remaining value, how much is the remaining? 1 lakh minus 23,400 minus 10,800. So the remaining shall be 65,800. 65,800 shall be the taxable value of perquisite, and this is how you have to value the perk. Now, another thing is there. Cubic capacity of the car is more than 1.6 liters. Then how do we value? Say, I own an Innova Krista and my employer is sponsoring the running and maintenance charges. Then how do we value the perk? You note down the actual running and maintenance expenses. Then you deduct 2,400 per month instead of 1,800 and you deduct 900 additionally if there is driver. The remaining shall be the taxable value of perquisite. So I'll repeat that particular point again, friends. Listen, car owned by the employee, maintenance and running charges met by the employer. Car is used for Official purpose, no personal benefit, nothing taxable. Personal purpose, actual running and maintenance charges met by the employer. Car is used for official as well as personal. In order to remove the difficulty, department comes up with an equation. What is the equation? You check the cubic capacity of the car. If it is less than or equal to 1.6 liters, you note down the actual running and maintenance charges. Deduct 1,800 per month. If driver is also there, additionally deduct 900 per month. Remaining, if any, shall be the taxable value of perquisite. If nothing remaining, nothing shall be taxable perquisite. If the cubic capacity of the car is more than 1.6 liters, you deduct 2,400 per month. And if driver is also there, additionally deduct 900 per month from the running and maintenance expenses. The remaining shall be the taxable value of perquisite. And this is how you have to value the perquisite. If the car is owned by the employee, maintenance and running charges met by the employer. Now, there can be one more alternative. Listen, car owned by the employer. You are owning a car. Now, the maintenance and running charges are also met by the employer. So, you own a car, you sponsor, you take care of the fuel and other expenses. In such a case, if it is used for official purpose, I'm not getting any personal benefit, nothing taxable. If it is used for personal purpose, actual running and maintenance charges plus I don't have to own the car as well. So plus 10% of the original cost of the car. For the ownership, proportionate value for a year is 10% of the original cost of the car. So listen friends, say for example, employer have a car having a value of 10 lakh. Every year the employer is incurring a running and maintenance charges of 50,000 rupees. Now you tell me, for one full year, I have used that respective car for my personal purpose. How do we value the perk? For ownership, you take the original cost of the car into 10%. That will be 1 lakh. Plus the running and maintenance charges of 50,000. So that will be 1,50,000 shall be the taxable value of perquisite. So if the car is used for exclusively personal purpose, actual running and maintenance charges plus 10% of the car for the proportion of ownership. Now, that shall be the taxable value of perquisite, and it will be taxable only if it is a specified employee. Why? Because the car is owned by the employer and given to the employee. Then that will be taxable only if the employee is a specified employee. In the other case, employee owns the car and asks for the reimbursement, it will be taxable in the hands of all employees. Hope you remember the shortcut method. Now, if the car is used for personal purpose as well as official purpose, that means if the car is used for mix of official purpose as well as personal purpose, how do we value the perquisite? And that's what we are about to discuss right now. If the cubic capacity of the car is less than or equal to 1.6 liters, then they are giving again a statutory figure. You don't have to write down the actual running and maintenance charges and deduct something. Rather than that, what department say? Car is owned by the employer. Maintenance and running charges met by the employer. Car is used for official as well as personal purpose. And the cubic capacity of the car is less than or equal to 1.6 liters. You consider 1,800 per month as the perquisite value. Driver is also there. Consider additional 900 per month as the perquisite value. This is what the department say. Say for example, Swift car owned by the employer, given to the employee, and the maintenance and running charges are also met by the employer. And the car is used for official as well as personal purpose. How do we value? 1,800 for Swift plus driver is also there plus 900 into 12. So this is how you have to value the perk. So you tell me how much is 1,800 plus 900? That will be 2,700. That into 12, that will be 32,400 shall be the taxable value of perquisite. Now, if the cubic capacity of the car is more than 1.6, say if it is an Innova Krista, how do we value? Instead of 1,800, it is 2,400 per month. Driver is also there, 900 per month. So 2,400 into 12, driver is there, 900 into 12. So that shall be the taxable value of perquisite, and I hope it is clear. Now friends, let's understand what if the car owned by the employer, maintenance and running charges met by the employee, official purpose, no perquisite. Personal purpose, only the ownership benefit I am getting because maintenance and running charges met by the employee, car owned by the employer. Then personal purpose, full usage, then only the ownership benefit I am getting, that is 10% of the original cost of the car, as taxable perquisite in the hands of specified employee only because car owned by the employer and given to the employee. Official as well as personal purpose, then 1.6 liters or less case, then 600 per month shall be the taxable value. If driver is there, 900 per month. If the cubic capacity is more than 1.6 liters, 900 per month. A driver is there, additional 900 per month. So in the hands of specified employees only. So very simple friends, there are 2-3 alternatives. Let's summarize this. Car owned by employee, maintenance running charges met by employee, no perquisite in whatsoever manner because I am not getting any personal benefit. Car owned by employee, maintenance running charges met by employer, official purpose, nothing. Personal purpose, running and maintenance charges. Official as well as personal purpose, note down the running and maintenance charges. Cubic capacity more than 1.6, you deduct 1000, 2400. Driver is there, additional 900 you deduct from the running and maintenance. Remaining shall be the taxable value of perk. 1.6 liters or less. If the cubic capacity is 1.6 liters or less, then write down the actual maintenance and running charges, deduct 1800 per month. Then the driver is there, additionally deduct 900 per month. Then this is how you have to value the perquisite. Now, car owned by the employer, running and maintenance charges met by the employer. Official purpose, no perk. Personal purpose, both ownership and running and maintenance charges. How do you value the ownership? You take the original cost of the car into 10% for a year plus actual running and maintenance charges. Now, car is used for official as well as personal purpose. Check the cubic capacity of the car. If the cubic capacity is more than 1.6 liters, then 2400 rupees per month shall be the value of taxable perquisite. Plus driver is there, additional 900 per month. Now, if the cubic capacity is less than or equal to 1.6 liters, then 1800 and 900. If the car is owned by the employer, maintenance and running charges met by the employee, official purpose, no perk. Personal purpose, only ownership benefit. So, original cost of the car into 10% for a year. And what if it is used for official as well as personal purpose? Depends upon the cubic capacity. Cubic capacity more than 1.6, 900 per month. Driver is there, additional 900 per month. Cubic capacity less than or equal to 1.6, 600 per month. Driver is there, additional 900 per month. This is how you have to tax the value of perquisite. Now, what to do with the recoveries? Recovery from the employee can be deducted except where statutory figures are used. Wherever we are using that statutory figures, that means 1800, 900, 2400, 600, 900. When we use the statutory figures, you are not supposed to deduct the actual recoveries from this statutory figures, because out of all, we are only taxing a small portion. From that again, you are not supposed to deduct the recoveries from the employee. So wherever we are using the statutory figures, recoveries from the employees are not deductible. In other cases, say for example, car owned by the employer, maintenance and running charges met by the employer, car is used for personal purpose. There we are not using any statutory figures. Ownership into ownership proportion, original cost into 10% plus actual running and maintenance charges. From there, you can deduct the actual recovery from the employee. Wherever you are using this statutory figures, you are not supposed to deduct any actual recovery from the employee. This is what the department says. So this is how you have to value a motor car, and I hope it is clear for you. Okay friends, so moving on to the next one. Next element is valuation of educational facility. Say for example, if the employer is taking care of the school fees of the employee's children or employee's brothers or employee's little sister, etc., then employee is getting a benefit because the employee not need to spend any penny from his pocket for the educational or the other educational activities of their dependents. So in such a case, how do we value the perquisite? That's what we are about to discuss. So if the educational institution is owned by the employer, say for example, the employee's children or employee's dependents are studying in a school which is owned by the employer, then how do you value the perquisite? What is the cost of education in similar institution, and that exact cost of education in a similar institution shall be the value of perquisite received by the employee. However, if the employee's children, if they are studying in a school owned by the employer, then they can claim an exemption of up to rupees 1000 per month per child. That simply means if the employee's children are studying in a school owned by the employer, then the employee can claim an exemption of how much? Rupees 1000 per month per child. That's what they are saying, and there is no restriction for the number of children where you can claim the exemption. So here you don't have any restriction for the number of children, and what they are saying is if the school have to be owned by the employer and the employee's children should study in that respective school. Now let me ask you one doubt. If the school is owned by the employer and employee's brother is studying in that respective school, can the employee claim the benefit of exemption of rupees 1000? No. If employee's children is studying in a school owned by the employer only, they can claim the benefit of rupees 1000 per child per month. That's what they are saying. Now, how about the other cases? That simply means if the employee's brother or employee's children is studying in an external school, an outside school, which is not owned by the employer, and the employer pays that respective school fees. In such a case, actual amount paid by the employer shall be fully taxable. He will not get the benefit of rupees 1000 is not available. So, to claim the exemption of rupees 1000, listen, the school have to be owned by the employer and the employee's children should study in that respective school. Then only they can claim an exemption of rupees 1000 per month per child, and there is no restriction for the number of children that you can have over here. Now friends, one important thing is there. What if the school fees of children is 1200? If the school fees is 1200 per month, then 200 per month shall be taxable. Over and above 1000 shall be taxable. That is a better way to study this respective topic. So this is all about the educational facility provided by the employer to the employee. Hope you remember that point. Moving on to the 10th one, say food and non-alcoholic beverages given by the employer to the employee. Say the employer is providing food or non-alcoholic beverages to the employee. How do you compute the value of perquisite? Very simple. Tea, snacks, etc. provided by the employer during office hours. Say the employer is giving free tea or samosa, chaats, etc. as light refreshments to the employee during the office hours. Nothing shall be taxable in the hands of employee, even though employee is getting a benefit. It's a very nominal amount, very small amount. So nothing shall be taxable in the hands of the employee. So tea, snacks, etc. provided during the office hours is not taxable. Now, free meals provided during the office hours. Say the employer is giving free meals to the employee and the employee is working in a remote area, or the employee is working in an offshore installation. What is a remote area? The employee is not working with the normal place of his duty. He is working in a remote area. Okay, in that remote area, say there is no food availability. So the employer himself is providing free meals to the employee. Now, or the employee is working in an offshore installation. What is offshore? Onshore means in India. Offshore means outside India. Say the employee is working outside India and the employer is providing free meals. In such a case, whether it is a remote area or whether it is an offshore installation, nothing shall be taxable. You don't have to value anything in the hands of the employee. It shall be fully exempted. Now, in a normal case, if the employer provides free meals during the office hours, then rupees 50 per meal shall be exempted. Over and above 50 shall be taxable as perquisite. Say for example, for a normal employee who is working in the normal place of his duty, employer is giving a meals of rupees 75 rupees per meals. In such a case, into 365 days. If he is getting such a free meal, then 25 rupees is the value over and above 50 into 365 shall be the taxable value in the hands of employees. So in a normal case, if the employer provides meals or he give food vouchers to the employee, then up to rupees 50 shall be exempted in the hands of employee. Whatever the value which is over and above 50 shall be taxable in the hands of employees. I hope that also is clear for you. Moving on with the next point, friends, item number 11, that is transfer of movable assets, that is transfer of ownership. Say for example, employer owns a respective movable asset and the employer transferred that respective asset and the ownership of that asset in the name of the employee, and employee is getting a benefit, yes or no? How do we value that respective benefit? Again, this is not it is not usage, it is transfer of ownership. What if it is usage? Movable asset, say motor car, we have already valued. Motor car, how to value the perquisite if it is given to the employee for using it? We already valued that as 10% of the original cost of the employer is the proportionate value of ownership. It is for usage. Now we are discussing about the transfer of ownership. And one more thing, say for example, say if laptop, computers, etc. have been given for using it to the employee, say there is a usage. If the employer is transferring laptops or computers owned by the employer and it is giving to the employee, say for example office laptop, etc. And the employee may use it for official purpose as well as personal purpose. When the employee when he reaches at his home, he may watch some movies or other web series, etc. in that respective laptop. But nothing shall be taxable in the hands of employees because transferring laptop for usage, nothing shall be taxable. If it is the ownership is transferred, then definitely you have to value the perquisite. So I'll repeat that point. If laptops or computers are transferred to the employee, that is only for the usage purpose, nothing shall be taxable in the hands of the employee. If it is transferred, if the employer is transferring the ownership, then you have to value the perquisite, and that's what we are about to discuss. Transfer of mobile asset, that is transfer of ownership. And how do you value? If it is a computer or a computer peripheral like printer, scanner, etc., then actual cost of the employer, you compute the actual cost of the employer. Then you deduct 50% depreciation for every completed year at WDV basis. Say for example, employer purchased the particular computer for 1 lakh rupees. He used it for 2 years. Then what you need to do? For the employer's usage, you need to deduct the value of rupees 1 lakh. How do you deduct the value? At 50% for every completed year. That means at 50% for year 1, that is 50,000 rupees. So the balance value will be 50,000 rupees. And again at 50% for year 2, completed year. So that will be 25,000. So the remaining value will be how much? 25,000. From that you deduct any recoveries from the employee. say in the year 3 or year 3 beginning or year 3 in between, employer has transferred that respective laptop for 10,000 rupees to the employee. That means employee have paid 10,000 rupees to the employer. So the taxable value of perquisite shall be how much? 15,000. So how do you value computer and other related peripherals? You take the actual cost of the employer, then you deduct depreciation at 50% for every completed year. The remaining value from that, if there is any recovery from the employee, you deduct that too. If there is any balance value, that shall be the taxable value of perquisite. And again, listen, if the employer is transferring that respective asset in year 1 itself, then you are not supposed to deduct anything. From the original cost, you deduct any recoveries from the employee, and the rest shall be the taxable value of perquisite. If the employer has used that respective computer or peripheral for 2-3 completed years, then only you are supposed to deduct the depreciation at 50% on the basis of completed years of usage by the employer. Now, case number 2, if the employer is transferring his motor car, that means employer is transferring the ownership of a motor car to the employee, then you take the actual cost of that respective motor car. You note down the actual cost of the motor car, then you deduct depreciation at 20% for every completed year of usage on WDV basis. On the remaining, you deduct the amount recovered from the employee. The remaining shall be the taxable value of perquisite. Say for example, employer had a car of rupees 1 lakh. It has been used for 2 years. Then year 1 depreciation at 20% on WDV basis. That means 20,000 you have to deduct. Then the remaining value is 80,000. On year 2, again depreciation at 20%. 20% on 80,000 will be 16,000. So year 3 the value will be 64,000 will be the value. From the 64,000, employee have paid say 20,000. So you deduct the 20,000 and the remaining 44,000 shall be the taxable value of perquisite. So for every completed year of use, you have to deduct 20% on WDV basis. From the remaining value, you deduct the amount recovered from the employee and the rest shall be the taxable value of perquisite. Now, what if it is some other assets? Say for example, a TV has been transferred. It is not usage, it is transfer of ownership. Then how do you value? TV, fridge, microwave oven, etc. How do we value? You note down the actual cost of that respective asset. Then you deduct depreciation at 10% on SLM basis. From the remaining value, you deduct the any amount recovered from the employee. The rest shall be the taxable value of perquisite. Say for example, a TV worth 1 lakh have been used by the employer for 2 years. So for year 1, at 10% means 10,000 rupees you have to deduct. Year 2 also, it is SLM. 10% means another 10,000. So the remaining value will be 80,000. From that, the employee have paid 20,000. So the remaining 60,000 shall be the taxable value of perquisite in the hands of employee. So this is how you have to value the assets if it is a movable assets transferred to that respective employee. So I hope that also is clear. So we have valued the perquisite if there is a transfer of movable asset. That means transfer of ownership of movable asset from the employer to the employee. Now, moving on. One more perquisite I want to say is like if the employer is giving sweat equity shares to the employee. That means that the employer is a company and the employer is giving what free shares of that respective company to the skilled employee to retain that skilled employee, sweat equity shares to the employee. We have to divide that sweat equity shares into 2. Say it is a listed share. If it is a listed share, then what you need to do? You need to take the highest value as well as the lowest value. Sorry, instead of highest and lowest, you take the opening as well as closing value of that respective listed share on a recognized stock exchange divided by 2. So you need to take the average of the opening and closing value of that respective listed share in the recognized stock exchange on the date of transfer, and that value shall be the taxable value in the hands of employee. If there is any recovery from the employee, definitely you can deduct that. And what if it is an unlisted share? In the case of an unlisted share, then the value have to be determined on the basis of fair market value, which is reported by a merchant banker. Whatever the fair market value which is reported by a merchant banker have to be considered as the value of that respective share if it is an unlisted share. I hope that point is clear for you. So friends, please listen. If the employer is giving shares, if it is a listed share, you take the opening as well as the closing price average on the date of transfer in a recognized stock exchange. If it is an unlisted share, you call a merchant banker and you make him value that respective share. Whatever the value which is valued by the merchant banker have to be considered as the value of that respective share, and this is how you have to value the perquisites. So we have completed the most important perquisites, the most frequently asked perquisites in salary. Now we have to complete the deductions from salary. Let's understand what all are the deductions that a person can claim from the salary. So first of all, what you need to do, you need to take the basic salary, DA, commission, bonus, perquisites, allowances, etc. and you add everything up, and that is said to be what? Gross salary. From the gross salary, a person can claim 3 deductions. Number 1, standard deduction. Number 2, deduction for entertainment allowance. Number 3, for professional tax. Let's discuss each and every one by one. First one is standard deduction. Standard deduction shall be either gross salary or rupees 50,000, whichever is lower. For the time being, we are discussing about the normal provisions. Normal provisions, that means the old scheme. If the assessee is opting for default scheme, that means 115B AC, then there is a separate computation that we will discuss afterwards. Okay, for the time being, if the assessee have opted for the old scheme, you claim the standard deduction. And how much is the standard deduction? Either the gross salary or 50,000, whichever is lower. Say for example, 40,000 is the gross salary, then standard deduction is 40,000. You cannot claim standard deduction 50 and you cannot say that it is a loss. That's not permissible. What if the gross salary is say 1 lakh? If the gross salary is 1 lakh, then you can claim standard deduction of how much? Maximum up to 50,000, and the remaining 50,000 shall be the taxable salary. So from taxable salary, a person can claim standard deduction, and standard deduction shall be either the gross salary or 50,000, whichever is lower. Now, if you have received any entertainment allowance, then you can claim a deduction for the entertainment allowance, provided you are a government employee. If you are a government employee and you are in receipt of entertainment allowance, in the gross salary there is entertainment allowance also, then what you need to do? You can claim a deduction for the entertainment allowance. This deduction for entertainment allowance can be claimed only by government employees. If you are a non-government employee and you are in receipt of entertainment allowance, that shall be fully taxable, not at all deductible. If you are a government employee and you are in receipt of entertainment allowance, you add that entertainment allowance as a part of your taxable allowance. Then you can claim a deduction after computing the gross salary. Now, how do you compute the deduction? Either 20% of basic salary or rupees 5,000 per year or actual amount, whichever is lower. There are 3 limits. Limit number 1, you take 20% of the basic salary. Limit number 2, 5,000 per year statutory limit, and limit number 3, actual entertainment allowance received. So the point is very simple. If you are a government employee, you can claim a deduction for the entertainment allowance that you have received. You have to add that entertainment allowance as a part of the gross salary. Then you can claim the deduction whichever is lower out of these 3 limits. Now, if you are a person who have paid professional taxes, then the actual professional tax paid by the employee is allowed as a deduction. If you are a person who have paid professional taxes, you can claim that actual professional tax paid by you as a deduction. So these are the 3 deductions that you can claim. Number 1, standard deduction. Number 2, entertainment allowance deduction. Number 3, deduction for professional tax. And one more thing is there. Say for example, the employee have to pay the professional tax. The employee have to pay the professional tax normally. It is paid from the pocket of employee. What if your employer is paying, say 2,000 rupees is the professional tax, employer is paying that 2,000 from his own pocket. The employer is paying that professional tax from his own pocket. If the employer is paying that professional tax from his own pocket, it is again a benefit received by you, because it have to be paid from your pocket. Your employer is right now paying that professional tax. So what you need to do, you take that 2,000 as a part of your gross salary. It have to be considered as a taxable perquisite. It have to be considered as a taxable perquisite. You have to add this 2,000 to the gross salary. Then you can claim this 2,000 as a deduction. So effectively, no adjustment. 2,000 have to be added, 2,000 have to be deducted. But it should be done while computing the answer in the exam. So if the employer is paying the professional tax from his pocket, you need to add it as a part of the gross salary. Then you can claim that same 2,000 as a deduction from the gross salary as well. Effectively, there is no impact. Numerical impact is not there. But this adjustment have to be done in your answer sheet to get marks. So I hope you are with me. You are able to follow what I'm saying. So moving on with the next thing, that is all about the deductions. This is how you have to compute the income taxable under the head salaries. Now friends, let's understand one more thing. Changes in computation under the salary if assessee has opted default tax regime under 115 BAC. Say the employee is paying taxes under 115 BAC, that is the default tax regime. How do you compute the income from the head salary? What are the differences? So let's understand in this manner. So difference number 1, if the employee has opted for 115 BAC, then the employee cannot claim the exemption under section 10 subsection 5, that is exemption for the leave travel concession. Hope you remember exemption under 10 subsection 5, leave travel concession, the traveling cost exemption. Entire traveling cost reimbursed by the employer shall be fully taxable in the hands of employee if the employee has opted for 115 BAC. And difference number 2, no exemption under 1013A. If the employee is in receipt of house rent allowance, normally you can claim an exemption under 1030A because it comes under the partly exempted category. But if the employee has opted for 115 BAC, it is fully taxable. You cannot claim the benefit of 1013A, that is the exemption for HRA, not allowable. Entire HRA received by the employee shall be fully taxable. Difference number 3, allowances under section 10, subsection 14, clause number 2 and clause number 1, except 1, 2, 3, 4. That simply means, what we can say is, if the employee has opted for 115 BAC, then the employee cannot claim any exemption for the allowances which is under section 10, subsection 14, clause number 1. That is the exemption depends upon actual expenditure. And clause number 2, fixed exemptions. Say for example, a uniform allowance, traveling allowance, research allowance, etc. And clause number 2 is children education allowance, hostel allowances, etc. So assessee normally, if he have opted for 115 BAC, he cannot claim any of the exemptions under 10, 14, clause number 1 and clause number 2. However, certain items under 10 subsection 14, clause number 1 and 2 is allowable. Which all are the allowable item? Number 1, you can claim exemption for the traveling allowance if you have expended it. You can claim exemption for the daily allowance if you have expended it. You can claim exemption for the conveyance allowance if you have expended it. And you can claim exemption for the transport allowance if you are a person who is dumb, deaf or orthopedically handicapped to a lower part of your body. Hope you remember these 4. So what is the speciality? These 4 can be claimed even if the assessee have opted for 115 BAC. You can claim exemption for these 4 even if the assessee has opted for 115 BAC. Except these 4, assessee cannot claim any other exemptions mentioned under 10 subsection 14, clause number 1 as well as clause number 2. This is what the department say. So difference number 3 is pretty simple. These 4 in both realms you can claim. Either BAC or old slab you can claim. Now apart from these 4, no other items under 10 subsection 14 clause number 1 and clause number 2 is allowable. No other items is allowable under if you are opting for 115 BAC. If you are opting for old slab, definitely you can claim the eligible items that we have already discussed. So that is adjustment or difference number 3. Allowances under 10 subsection 14 clause number 2 and 3 except these 4 not allowable. Okay, the rest not allowable. Now difference number 4, no deduction for the entertainment allowance. Even if you are a government employee, if the government employee has opted for 115 BAC, he cannot claim deduction for the entertainment allowance receipt. The entire entertainment allowance shall be fully taxable. Next difference, no deduction for the professional tax. If you are an employee who have paid professional tax from your pocket and you have opted for 115 BAC, you cannot claim deduction for the professional tax that you have paid. Then adjustment number, difference number 6, you can claim a standard deduction of up to 75,000. This is an added advantage. If the assessee has opted for 115 BAC, he can claim a standard deduction of how much, friends? Rupees 75,000 rupees instead of 50,000. So it's an added advantage. More standard deduction if you have opted for 115 BAC. And lastly, free food during the office hours, fully taxable. That is the benefit of 50 per meal is not allowable. If you are an assessee opted for 115 BAC, the benefit of 50 per meal, if you are receiving free food from your employer during your normal office work, you cannot claim the benefit of rupees 50 per meal. That is not allowable. Entire free meals provided shall be fully taxable. Benefit of 50 have been withdrawn. That's what the department says. So these are the 7 differences if the assessee has opted for 115 BAC. Apart from this, there is no other difference whether the assessee have opted for old or new or default. That's what you should know under the head salary. So by this, I can say all the theory related to salary is completely over. All the frequently asked theory we have discussed in a very detailed manner. Now we will solve some questions as well to make sure that your understanding in this concepts are concrete. So let's solve some questions now. Okay friends, now let's solve some questions to make our understanding better. Question number 1, we'll go with the question number 1, that is actually a September 2024. It's a past exam question from your September 2024 question paper. So let's read that question together. The particulars given below are of Mr. Radhe's income. Age is 47, posted in a private company in Delhi for the previous year 24-25. Number 1, basic salary. So before reading the rest, you should read the final requirement of the question, you are required to compute the taxable income, salary income of Radhe for assessment year 25-26, assuming that he has opted out of the default tax regime under 115 BAC. So Radhe has opted for normal provisions, not 115 BAC, old slab rates they have opted. Okay. Now, basic pay 35,000 per month till January 31st and 40,000 per month from February 2025. So what we need to do is 35,000 till January 2025. So we can write 35,000 into how many months, friends? 10 months. And for 40,000 on February and March. So 40,000 into 2 months. So you tell me how much is the total salary. That will be 4,30,000 will be the total salary for the whole year. So let's note down that respective salary. So basic salary 4,30,000. We are computing the tax total income from the head salary as per the normal slab rate. Alright, so let's read the remaining things. What is adjustment number 2? Dearness allowance of 30% of the basic salary and 54% of DA forms part of the retirement benefit. So the entire DA will be fully taxable. So 4,30,000 into 30% shall be the entire full DA. So that will be 1,29,000. So that shall be the taxable full DA. So we will write full DA 1,29,000 shall be taxable. Then what is next? Leave encashment for the previous year 24-25 is 10,000. So the question is not saying that he is retiring at the year end. So this leave encashment is during the period of service. Period of service, and it shall be fully taxable. You will not get the benefit of exemption, because if you want to claim the benefit of exemption, that leave encashment have to be received at the time of retirement. So this is during the period of service and it shall be fully taxable. So leave encashment 10,000 fully taxable. Then what is next? He received a salary for the month of April 2025. The relevant PY is 24-25. April 2025 comes in the next year, but he received that April month salary in advance on 31st March 2025. So April month salary means it is 40,000, right? So that 40,000 would be obviously taxable in the year 2024-25. Also, he received an arrear salary for the month of March 2024. Month of March 2024 means in the year 2023-24. It is due in the year 23-24 and it would have already added in the year 23-24. This is received on March 2025. It was arrear. It was a kind of a payable or something. So it would have been taxable. It is already taxable in the year 23-24. So you don't need to add that March 2024 salary along with 24-25 PY. I hope you understood. Because March 2024 salary shall become due in the year 23-24, and that will form part of the basic salary for the year 23-24. If it is received in the year 24-25, then again you don't need to add that respective salary. So this 40,000 advance of salary definitely will be taxable, because basic salary shall be taxable on the basis of due or receipt, whichever is earlier. So this 40,000 shall be taxable over here. So April's salary in advance, 40,000 you have to definitely tax as a part of the taxable salary. Then what is next? His employer gave him a rent-free accommodation fully furnished in Delhi. Delhi means population is more than 40 lakh from 1st April 2020. This house is owned by his employer. So house owned by the employer. During the previous year 2021, the perquisite value was valued at 39,000. 2021's perquisite value is given. It is of no use. The employer also provided him facility of gardener. So gardener have been given to maintain this house. So a gardener have been given. The salary of the gardener was 1,000 per month. So for the gardener, 1,000 into 12 months, that will be 12,000 rupees shall be taxable perquisite. Furniture and appliances provided with the house were bought by the employer at an aggregate cost of 1,50,000 on 1st January 2021. So furniture have been given. So value of furniture is 1,50,000 is the cost of the furniture into 10% shall be the value for a year. That will be rupees 15,000. So let it be there. Electricity and water bills for 4,000 per month for the said house were paid by the employer. So electricity 4,000 per month into 12 months, that will be 48,000. Now we have to value the unfurnished accommodations value as well. How do you compute the value of unfurnished accommodation? Salary into 10% shall be the value of unfurnished accommodation. For the purpose of valuing RFA, what all are the components that forms part of the definition salary? Basic salary obviously will form part of the definition. Entire DA will not form, only DA forms part of the retirement benefit will be considered, that is 54% of 1,29,000, because 54% of the DA shall form part of the retirement benefit. That's what the question say. So 129,123 into 54%, and that will be 69,660 will form part of the retirement benefit, and that DA will form part of the definition of salary for the purpose of rent-free accommodation. Hope you remember the theory. Now, leave encashment. Definitely you have to consider. Advance salary you should not consider, because that is basically taxable on the basis of due or receipt, whichever is earlier. So that 40,000 is the advance of salary. That have to be considered as a salary for the next year while computing rent-free accommodation, not in this year. Now, what else? Is there any other thing you have to consider? That also, there is a employer also spent 50,000 refresher course, not required. Then during the previous year his wife has been admitted in a notified hospital, kidney disease, not required. So that is a definition of salary. So can you add these items together? So 4,30,000 plus 69,660. So 69,660 plus 10,000. It shall be 5,09,660 shall be the salary for that respective year. So 5,09,660 into 10%, and the rent free unfurnished accommodations value shall be 50,966 shall be the value of that respective house. Now, furniture we have already valued 15,000. Now, domestic servant we have already valued 12,000. Now, electricity we have already valued 48,000. Now, before that, let me ask you one more doubt. They have given inflation index numbers for the year 1920, 2021 and 24-25. You don't consider that, because hope you remember that inflation thing is with effect from 2023-24. So if 23-24's perk value was given in the question, then you have to consider that perk value and you need to index it to 2024-25. Okay, so that perk value is actually missing in the question, so you don't have to do any effect of indexation. Hope you remember that respective note, because this is with effect from 23-24, so you don't have to inflate the value and check the possibility of that indexation effect. Now, moving on with the next point, the employer also spent 50,000 on refresher course for upgrading Radhe skills, not taxable, because it is not considered as a personal benefit and hence nothing shall be taxable. Now, during the previous year, his wife had been admitted in the notified hospital for the treatment of kidney disease, specified disease plus notified hospital, and the hospital bill amounting to 3,50,000 were paid by the employer, not taxable. Not taxable. Hence, that's it. Now, let's compute the gross salary, friends. So, which all are the taxable components? 4,30,000, 129, 10,000, 40,000, then 50,000, 966, 15,000, then 12,000, 48,000. So, if you add all these things together, your total will be 734,966. From that, you can claim standard deduction at 50,000, because assessee is not planning to pay taxes under 115 BAC. So, your standard deduction is only 50,000. So, if you claim that, your taxable salary shall be 6,84,966, and you can round it off to 6,84,970, and that shall be the taxable income from the head salary, and I hope it is clear for you. So, let's solve one more question, friends. So, question number 2. Question number 2 is actually a past exam question, that is November 2022, which has been tested for 8 marks, and let's solve that question as well. Mr. B is a sales manager in PQR Limited. During the previous year 2024-25, he has been received the following towards his salary and allowances and perquisites. Now, you are required to compute income chargeable to tax under the head income from salary, assuming he does not opted for the provisions of 115 BAC. Alright, what will be the income under the salary if he opts for the provisions under 115 BAC? So, they have tested both 115 BAC as well as the old. So, let's solve it on the old first, thereafter we will compare and we will solve it under 115 BAC. So computation of salary income as per the default normal tax rate. So computation of salary income as per normal slab rate. Acha. So starting with the first one, friends, they are saying basic salary. Basic salary will be obviously the first component, and let's understand what are they saying in the question. So how much is the basic salary? Basic pay 85,000 per month up to December 2024. December 2024 means 85,000 into how many months? It is 9 months. Plus thereafter increase of 2,000 per month. So for January it is 87, February 87, March 87. It is not January 87, February 89, then March 91. It is not like that. 2000 from January. Okay. So that doesn't mean from every month from January you will get an additional 2000. Not possible. That's illogical. So 87,000 for the January, February and March, that is into 3 months. So the total salary will be 10,26,000. So 10,26,000 shall be the total salary, basic salary. So let's write down that 10,26,000. 10,26,000 shall be the total taxable basic salary. Now, what is point number 2? Second one. That is the dearness allowance. 40% of the basic salary forms part of the retirement benefit. So 40% of 10,26,000. How much is 40% of 10,26,000? And that will be how much, friends? That will be 4,10,400. 4,10,400 shall be the dearness allowance. So DA forms part of the retirement benefit shall be 4,10,400. Superb. Then what is next? Bonus 1 month basic pay based on the salary drawn during January month. So January month salary is 87,000. So your bonus also will be 87,000. So bonus, we are assuming that it is actually received. Okay. So 87,000. The question is saying bonus 1 month pay based on the salary drawn during January month every year. So he have received the following. So bonus is obviously received. And then he contributes 14% of basic pay and DA towards his recognized provident fund, and his employer company contributes the same. For his contribution, he will get a deduction under 80C, but you don't consider that in the question, because in the question they are asking us to compute only income from the head salary. 80C is a chapter 6A deduction which can be claimed from the gross total income, not from the salary income. So you have to ignore the effect of employee contribution to RPF. But for the employer contribution, which is in excess of 12% of the salary plus DA, you have to consider it as a taxable element. So what we need to do is employer contribution to a recognized provident fund. 14% of basic plus DA forms part of the retirement benefit. That's what the question says. So 10,26,000 plus 4,10,400 into 14% is the actual contribution. So 10,26,000 plus 4,10,400 is 14,36,400 into 14%, that is 2,01,096 is the actual contribution. Now, how much is the exempted? Exemption shall be 12% of basic salary plus DA forms part of the retirement benefit plus commission if it is expressed as a fixed percentage of total turnover. But in this question, they are not mentioning anything related to commission, so you can ignore the effect of commission. So 10,26,000 plus 4,10,400 into 12% is the exemption. So into 12%, and that will be 172,368 is the exemption. And how much is the remaining amount, friends? 201,96 minus this figure will be 28,728 shall be the taxable contribution of the employer to that respective recognized provident fund. All good. Next is traveling allowance 5,000 per month towards on duty tours. Acha. So he has been received traveling allowances for the purpose of duty to. So it is exempted under section 10 subsection 14 clause number 1, traveling allowances for official purpose. Now, since they are saying on duty to's, he might have done his duty already and he might have expended that entire 5,000 per month. That is not clearly given in the question, but we are assuming that that is fully exempted. Why? Because, that is fully expended. Why? Because he have already done his duty. It is given for duty to's. He might have already performed that respective to's, and he might have already expended that 5,000 per month, and we are claiming full exemption for that 5,000 per month. So traveling allowance, I am writing traveling allowance, assuming it is fully expended and exempted as well, nothing shall be taxable. Then next one, research and training allowance of 3,000 per month he received. The question is not saying whether he have expended that research allowance or not, because for traveling allowance he might have performed his duty for the year and he might have expended something. But research allowance, we don't know whether he have done some research in that respective year or not. That is vague. So I am assuming that he haven't done any research and it is fully taxable. You can write your assumption. Okay, you can take the alternative assumption as well. What is the alternative assumption? We are assuming that the entire research and training allowance have been fully expended. You can assume that in that manner as well, no problem. But I am assuming that since they are silent about the expenditure regarding the research allowance, I am assuming that it is not expended, so it shall be fully taxable research allowance. So RA, research allowance. And how much is the research allowance, friends? 3,000 per month into 12, that will be 36,000. Shall be fully taxable allowance. Normally you can claim an exemption, but it is under section 10 subsection 14 clause number 1. But 10 subsection 14 clause number 1 exemption depends upon actual expenditure. Here I am assuming that it is not expended for any research because the question is silent about any research and all. So I am assume that he haven't expended that respective allowance. Children education allowance of 600 per month per child for his 2 sons and 1 daughter. So 3 children, 600 per month. So children education allowance 600 into 3 children into 12 months. How much is the total? 600 into 3 into 12, that will be 21,600. You can claim an exemption under section 10 subsection 14 clause number 2, that is fixed exemption. 100 into maximum 2 children into 12 months, that is 2,400. And how much is the remaining? 2,400 minus 21,600, that will be 19,200 shall be the taxable allowance. Now, what is next? Accommodation owned by PQR Limited was provided to him in Hyderabad. They are saying Hyderabad and we don't know the population of Hyderabad. So we are assuming that the population of Hyderabad is more than 40 lakhs for the whole year, and the furniture of 2 lakh has been provided from 1st October. Furniture of 2 lakh has been provided from 1st October, but accommodation have been provided for the whole year. So we need to value the accommodation. For valuing the accommodation, we need to compute the salary. So let it be there. I am for the time being skipping this adjustment. Let's complete the other, then we will come back to this respective adjustment. Then next one, reimbursement of medical expenses on treatment in a private hospital 15,000. That is definitely a taxable perquisite. So that is a taxable perquisite. Taxable perquisite, medical treatment in private hospital. How much is that medical expenditure, friends? 15,000. That is definitely a taxable perquisite. Then what is next? Next one is medical allowance of 1,500 per month. Medical allowance is fully taxable. So 1,500 into 12 months. Medical allowance shall be fully taxable. So 1,500 into 12 months, it will be 18,000. Medical allowance, it shall be fully taxable. So we can write medical allowance 18,000 fully taxable. Then what is next? Company paid him a premium on medical policy purchased on his health insurance premium paid by the company. We are assuming that is an IRDA approved insurance, because I've already said you, to run an insurance company in India, you must take an approval from IRDA. Otherwise, it is impossible to run a insurance business in India. So we are assuming that it is IRDA approved. So it shall be fully exempted, not taxable as perquisite. That's it. Now let's value the salary and the perquisites. Now for the purpose of rent-free accommodation, what all are the components that comes under the definition of salary? Obviously basic salary will come 1026. Then DA will be coming 4,10,400. Bonus will come 87,000. Excess contribution to PF will not come, hope you remember, excluding perquisites as well as excess contribution to recognized provident fund. That will not come. Traveling allowance, nothing taxable. Research allowance, that will definitely come. It's a taxable allowance. Then children education allowance, taxable allowance. 19,200 it will come. Then medical allowance, taxable allowance, it will come. Then next is taxable perquisite, it will not come. So how much is the total for the purpose of valuing rent-free accommodation? 1026, then 4,10,400, then 87,000, then 36,000, then 19,200, then 18,000, and how much is the total? 15,96,600. So we will write rent-free accommodation. So 15,96,600 is the total into 10%. Into 10%, and it will be 1,59,660, and they have been provided some furniture for 6 months. So from 1st October 2024, furniture have been provided. So the original value of furniture is 2 lakh into 10% for a year into 1/2. So that will be 10,000 for the furniture. So adding these two, it will be 169,660 will be the total amount coming, 169,660 plus 15,000. Then is there anything else pending? Nothing is pending. Everything have been provided. Now let's compute the gross salary. So let's compute the gross salary, friends. It is 1026,123 plus 4,10,400 plus 87,000 plus 28,728 plus 36,000 plus 19,200 plus 18,000 plus 169,660 plus 15,000. That will be 18,09,988. 18,09,988. From that you can deduct standard deduction 50,000. So the remaining amount shall be how much? 17,59,988 shall be the taxable amount as per the old scheme. Now let's compute the amount under 115 BAC. So computation of salary income under section 115 BAC. Basic salary, there is no change. Full amount 1026 will come. DA, there is no change. 410,400 will come. Bonus, there is no change. 87,000 will come. Then what is next? Excess contribution to the PF, excess contribution to recognized provident fund. Recognized provident fund, there is no change. That 28,728 will come. Then what is next? Traveling allowance, even if the assessee have opted for 115 BAC, you can claim the exemption. Research allowance, fully taxable. No change. Research allowance 36,000 definitely will come. Then children education allowance, fully taxable. Children education allowance shall be fully taxable. You will not get the benefit of rupees 100 per child per month up to 2 children. You will not get. So children education allowance fully taxable, that is 21,600. 21,600 shall be fully taxable. Then what is next? Next shall be, next point, what's the next item? Rent-free accommodation. There is a change in the rent-free, sorry, before that medical allowance is there, fully taxable medical allowance. I'm writing MA, medical allowance, fully taxable 18,000. Then for the purpose of rent-free accommodation, there is a change in the salary. Yeah, what is the salary for the purpose of rent-free accommodation over here? 1026, then 410, 400, bonus 87,000, then excess contribution is not considered, research allowance 36,000, taxable allowance, children education allowance is different, that's the difference. Full 21,600 shall be taxable, medical allowance 18,000. So what is the total for the purpose of rent-free accommodation? 1026,123 plus 4,10,400 plus 87,000 plus 36,000 plus 21,600 plus 18,000, and that will be 15,99,000 shall be the what do you say, salary for the purpose of rent-free accommodation into 10%. So rent-free accommodation it will be 159,900 shall be the value of perquisite, and for the furniture it is the same. There is no change for the valuation of furniture, that is 10,000. Then perquisite, that is the medical treatment, and there is no change for the figure. Taxable medical perquisite shall be 15,000. Now let's compute the gross salary. So only differences for the children education allowance. Due to that change, RFA value also changes. Okay. So tell me friends, how do you value this? 1026,123 plus 410,400 plus 87,000 plus 28,728 plus 36,000 plus 21,600 plus 18,000 plus 159,900 plus 10,000 plus 15,000, and the total value will be 18,12,628. 18,12,628 shall be the total value. Adding these two, and you can claim standard deduction at 75,000 shall be the standard deduction. So you claim 75,000 as the standard deduction, and how much will be the difference? That is 17,37,628 shall be the taxable income from the head salary. So this is how you have to compute the amount. So I hope that question is clear for you. So this is how you have to compute the answer. Now friends, apart from these questions, those who are using workbook, please take your page number 74 and solve question number 39. Page number 71, question number 36. Page number 75, question number 40. So these three questions, these are the variety questions from the frequently asked areas. So if you cover this much, your salary chapter is set, friends. So these are the most frequently asked areas from the past 10 examination question paper. So I want all of you to cover minimum this much. This should be the focus area, critical area, high alert area. So you have to complete this, and by this I can say the revision for the chapter salary is completely over. I hope you got a grip over this respective chapter, and we have more chapters coming. So stay tuned to the respective channel. Take care and bye-bye, my dear friends. Hello my dear ones, this is CA Jose Kurian, and this video is to inform you about how to purchase our recorded lectures and textbooks from the website. Very simple, you log on to www.cajosekurian.com, and in the website you scroll down and you can see all our books. That is handbook multicolor for CA, CMA final as well as for inter. Then we have workbook which contains past exam 30 plus question papers as well as RTPs. That is also for CA final, CMA final and CA as well as CMA inter. Now for the recorded lectures, you go up, take the website, then click on the classroom, and in the classroom you can scroll down and you can see all the courses that we are offering. Select your course, make payment, and the course is all yours. It is instant access. Now, what are the courses that we are offering? We are offering CA final English as well as Malayalam, CMA final English as well as Malayalam, CA inter English as well as Malayalam. Now friends, what are you waiting for? Get your access today and unlock the pathway to your success. All the very best. Take care and bye-bye.